Just tune in to Romance.
of daytime sleepiness due to obstructive sleep apnea, all through deadlines, and all through Family Fun Day. Imagine what that could mean for you. Pull an all-dayer with Sunosi. Once daily Sunosi improves wakefulness in adults with EDS due to OSA. It works through 9 hours in 12 weeks in a clinical study. Sunosi does not treat the cause of OSA or take the place of your CPAP. Continue to use any treatments or devices as prescribed by your doctor. Don't take Sunosi if you've taken an MAOI in the last 14 days. Sunosi may increase blood pressure and heart rate, which can increase your risk of heart attack, stroke, heart failure, or death. Tell your doctor if you have a Here's your margarita. Sorry, we're out of Cointreau.
Well, my good man, if you're out of Cointreau, you're out of margarita. Now, Kathy, would you be a dear and go take a hole and bury this?
6:30 this morning out. Put the dogs out, run them upstairs, got to cook the house, I didn't smell the helicopter. Got coffee for Jess and I. Finished my chocobo dig. Bro, Chicago for us ever use that play. I mean, bro, I switched servers. I'm never playing on one server. So I still play on East Central and West. Dude, I am back. It is currently 8:02 a.m. right now. He's gonna cap that, so I'm just gonna go grab it. Shinja, what word? Nathan? Remember JJ gets tomorrow? Hell yeah, bro. Cannot wait. All covered. JJ right now. Loving it. I don't know if I want to play CS later today. It'll probably be a Fortnite only. Fortnite ownery. I'm gonna shoot a text to close these trying to get the game in. Even though we can't call faster, it really doesn't just work. I don't want them to just win. Yeah, John has been texting me. I mean, no one has. I'm going to dinner. Well, my parents have. Someone says, don't be disrespectful and don't spit on other people. Okay? Today's my wife's father-in-law's son's birthday. Wow, dude. Happy birthday, man. Morning, yeah. You're playing the original Lego Star Wars? I don't. Appreciate the $5 super chat, awesome. Make money, get all the boys together, buy a house. That's awesome. Good. Is that crazy, guys? How Jess? Oh, Joe was calling me. Hello? What's up, bro? I have more wins in quarterback today than messages and calls you've given me since you've been back in Illinois. That's crazy, dude. So, 0? 1. Wow. I hope you're running to me today. Yeah. I think I just filled a couple of eyes. I thought it was you already. Okay. I love guy. What do you think of the Fortnite? I did see the line, sold out the tickets. It's gone out of my face, dude. First time they ran out since, like, what, 2002? Or since they've been at Ford Field. Morning, and yeah, Jimmy Tanner did a parody on Doc imitating him. I've done that before.
Cable box. Cable box. Panoramic. Cable
CPI
box.
on Thursday, PPI on Friday. Mike McKee has more. Morning, Mike.
Good morning, John. Well, there's not a lot happening this week, but what is happening is going to get a lot of interest in the markets. We start the week with this. John Williams, president of the New York Fed, one of the big three on the Open Market Committee, talking with the New York Times, saying, of course, we're all data dependent, and based on what I see today, to me, the debate is really about, do we need to do another rate increase or not? That's going to be a question that we'll get some answers this week as we do get CPI later in the week. But look what's happening over the last couple of weeks. The yield curve is steepening as the markets begin to think about the Fed lowering rates at some point. Now, is it because the real rate is going to creep up as inflation falls? The only thing I would say here is the negative yield curve doesn't predict recessions. Recessions don't start until the yield curve starts to steepen, and that's what we're seeing right now. Something to worry about? We'll get another idea of what the market thinks this week when we have three auctions. Watch the 10-year and the 30-year. And the 30-year, John, has gone up about 30 basis points over the past week. Remember when that happened in Great Britain? We had some issues in the markets. So far, nothing here. But keep an eye on what happens with those yields when those auctions take place. And then CPI, that's the big one this week. A lot of headlines are going to focus on the headline number, which is going to go up because of base effects. There was no inflation of July last year, but the Fed's going to be looking at the month-over-month number. Does it continue to go down? 0.2 is the forecast. If we get that, the Fed will be reassured that at least we're still making the same kind of progress. They do have one more CPI report before they have to vote again, but decline in CPI would give them a little bit more of a sanguinity, I guess you'd say, about where things are at the moment, as John Williams was talking about.
Mike McKee, thank you, buddy. Appreciate it. For the update on the Fed speak as well. The runway, the calendar, August 10th for CPI, September 13th. The next two CPI prints before that Fed meeting later on. Keith Lerner, let's start with the Fed debate. Let's go there. Is now the time to shift the debate from how high to how long rates will be this high?
Yeah, well, our story all this year was that the Fed was going to be higher for longer. And I think their reaction function will be slower to cut inflation that we've seen over the last year. So I think the discussion right now is still, it's probably close to a coin flip as far as if they raise rates one more time. We think they more likely have a lot of data between now and then, and that's likely it. We think they stay on hold. And what's interesting, Jonathan, on the other side of this cycle, since they'll likely be slower, we also think any type of economic rebound that you normally get from monetary policy being cut will be more constrained relative to history. And from a broader market perspective, I don't think this is the main driver right now. Again, we've just raised rates over 500 basis points. Whether we do another quarter or not, to us, is not the main story. The main story in our view is earnings. Earnings have been stronger than expected, but again, we think we're more likely in a consolidation here near term.
Earnings better than expected, the data better than expected. Oksana, let's talk about the how high for how long, and the how long specifically. Oksana, I won't ask you how long you think the Fed is going to hold rates for, but I would like to know from the work that you've done, looking at the maturity profiles of corporate America, if there is a duration in time where this becomes really problematic for corporate America. Is that maturity wall 6 months out, a year out, 18 months out? How close is it?
So if we consider the fact that, of course, most of the defaults happen in the junk-rated part of the corporate sector, right? That maturity wall is coming up in 2025, and the market typically starts to anticipate who is going to be able to refinance and who is not, call it roughly a year out. So I think as long as rates remain here for the next, 6 months, 10 months, over the next year, call it, or less, it will become an increasingly more significant problem. And in terms of what history tells us, there is absolutely periods in very recent past, like the late 90s, for example, where the Fed kind of just held the Fed funds rate in that, 4 to 5% range for several years, between roughly 95 and 99 or so, because inflation remained elevated, above 3%. And so it's not unconscionable that we could stay here with this. If the labor market continues to be strong, there's certainly no impetus for the Fed to absolute absolutely every right to step back and say, all right, let's see what happens here. The economy has continued to be strong, and let's see how this unfolds. And that will be problematic for the weaker balance sheets that absolutely require that cheap financing and cannot exist without it.
Oksana, Keith, stick with us. Your equity market at the moment about 17 minutes out from the opening bell. Futures positive here by 0.5%. Let's get you some movers. Here's Abby.
Well, John, let's start up with the shares of Tesla, which are sort of all over the map. They had been up slightly. Now they're down about 0.7%. This after the company filed an 8K. They have named Vaibhav Taneja as the CFO. He is replacing Zachary Kirkhorn. Zachary Kirkhorn has been with the company for 13 years. He's stepping down after 4 years in the CFO role, but he will be sticking around through the end of the year. Berkshire Hathaway up about 1%, narrowing in on an all-time high. This, of course, is they reported earnings and their cash pile reached $147 billion. Operating profits jumped 7% on a year-over-year basis, so a positive quarter there. And then Palantir reporting after the bell up 0.6%. Well, this is going to be a big AI test, John. The stock up about 135% on the year. Will the data analyzing company, will they be able to back up that gain with progress on AI?
Abby, thank you. Coming up on this program, the White House on Bidenomics.
We had record levels of recovery from the global pandemic and its ensuing economic catastrophe, and now we are seeing what steady, stable growth looks like.
President Biden pushing forward his economic agenda as the warnings pile up. That conversation up next.
Countdown to the opening bell is brought to you by Crypto.com, the world's fastest growing crypto app.
If you had W-2 employees in 2020 or 2021, you could be eligible for cash payments of up to $26,000 per employee through the government's Employee Retention Credit Program. Find out if you're eligible at wondertrust.com.
Too many companies are taking shortcuts and relying on estimates in ESG reporting, and CFOs need to get ahead of that. ESG reporting has become as important as financial reporting. CFOs have a critical role in becoming the storytellers for the ESG reporting. CFOs are uniquely positioned to work across different functions to extract the relevant data to meet the disclosures requirement as mandated by the government or the regulators.
Somebody would ask her something and she would just walk right past them because she didn't know they were talking to her. I just could not hear.
I was hesitant to get the hearing aids because of my short hair, but nobody even sees them.
Our nearly invisible hearing aids are just one reason we've been the brand leader for over 75 years.
When I finally could hear for the first time, I started crying. I could hear everything.
Call 1-800-MIRACLE and schedule your free hearing evaluation today.
Big corporate types, would you stop calling each other rock stars? You're a rock star. You are a rock star.
No one called your coworkers rock stars.
Look, it's great that you use Workday to transform your business.
But it still doesn't make you a rock star.
So unless you work with actual rock stars.
Hi, I'm Oswald.
Hello, Oswald.
Hey, you are a rock star. I wasn't going to say it.
Steady, stable growth. It's what we would want in the economy, that we had record levels of recovery from the global pandemic and its ensuing economic catastrophe. And now we are seeing what steady, stable growth looks like. 187,000 jobs created, bringing the total since President Biden came into office to 13.4 million, at the same time that we continue to see record low unemployment rates.
The White House promoting President Biden's economic agenda. Morgan Stanley's Mike Wilson has a warning. Fiscal dominance has been a key component of our boom-bust framework. This year, another strong fiscal impulse has reasserted itself. Should it reverse, it could call into question the significant re-acceleration in growth that is now priced. Anna Wong of Bloomberg Economics echoing that sentiment, writing this: if the recession we predict this year is delayed rather than averted, and the Fed ultimately has to hike more than we currently anticipate, the most likely culprit will be Bidenomics. Kelly Lyons down in D.C. with more. Hey, Kaylee.
Hey, John, therein lies the rub for President Biden, because right now, in theory, the economy is working in his favor with inflation coming down and the labor market and growth still incredibly resilient. And he does say that is due to Bidenomics, to the legislative accomplishments he has seen in this administration, the passage of the Inflation Reduction Act, of infrastructure spending, and the CHIPS Act as well. And that's the messaging he's going to be taking with him to the Southwest this week. He leaves for Arizona later this afternoon. Will be traveling to New Mexico and Utah as well, trying to promote this message that his policies are contributing to stronger economic growth. And economists do agree with him. The issue is, while it's working in the near term, it may not work as well in the long term. If, in theory, these policies continue to stimulate demand and inflation can't come back down to the Fed's target, could mean tighter policy for longer and ultimately a recession down the line, to the point that our own Anna Wong was making. You also have to consider other factors here as well. The idea that this fiscal stimulus comes with an increase to the debt load, and it's that very debt load that was one of the problems that Fitch pointed to last week when stripping the U.S. of its AAA credit rating. And there's some other economic factors that could come into the picture this fall. A government shutdown that is looking increasingly likely to happen should Congress not agree on spending packages, as well as the resumption of student loan repayments come October. Both of those forces could start working against the economy in theory. So while the Bidenomics messages is what the president is trying to tout at the moment, it is not yet reflecting in his approval rating on the economy or overall, and that could get more difficult as we get closer to 2024 and November, when he's seeking re-election, John.
Kelly, thanks for the wrap-up down in Washington, D.C. on the latest Bidenomics, the good and the bad, depending on what seat you're in at the moment. Keith Lerner, have you ever seen deficits this big with unemployment this low?
No, it's surprising, like I said, how resilient things have been. And again, I think one of the main things for this economy is just, how strong this fiscal stimulus and how prolonged it's been. And a lot of the spending is still going to happen over the next several years. So it's overall, a strong economy. But that inflation, though, as we mentioned, it's going to be a lot tougher getting inflation from, say, 9 to 4% down to 2. And I think that's going to be the challenge. And a lot of consumers, as they go out into the election year, are still focused on these high prices. Even if inflation comes down, when you go to the grocery store, those prices are still a lot higher than they were a few years ago. So I think that's going to resonate. We're also seeing gas prices as well. And as we go back more near term, that CPI report, there's a chance we're actually on the headline number going to actually see a little bit of an increase, which is going to be a change from the trend we've seen over recent months.
The CPI on Thursday, PPI on Friday. Oksana, Jim Bianco researcher, said he thinks inflation is bottoming out for the year. He doesn't think from here that you're going to see a continued deceleration. What you'll see, to what Keith just said, is inflation picking up again into year-end. Do you sense the same thing?
I definitely think that that's a very distinct risk, and we're seeing, of course, energy prices perk back up, where there's a lot of questions around other commodity prices given the war in Ukraine and the wheat prices. But there's also kind of, John, a perfect storm around, to the extent that we are talking about interest rate levels, right? And that's why we're talking about inflation. It's the cost of capital, which of course impacts everything. There is kind of that perfect storm in the works right now, and inflation is just one of the moving parts. You've had this higher than expected amount of treasuries at auction, or the Treasury is going to need to borrow. You've had DOJ try to normalize its policy. You've had the ECB, of course, continuing to raise. You've had really a lot of tremendous amount of spending, as was mentioned, really unprecedented for non-war times. And so there are a lot of sort of things coming together, and one of them has been notably a rise in inflation expectations, right? So which kind of underpins or emphasizes the somewhat academic nature of the CPI, in that your average consumer may actually have a different, or may feel that they're having a different experience, which can more inflation expectations, and we've certainly seen them move up. And that also then contributes to how the Fed thinks about it. What do they do here? So there are a lot of factors that are coming together right now to push that long end of the curve higher, and I think that will continue to be a risk. And that steepening may continue to have some more legs from here.
Interesting. Ahead of a ton of supply a little bit later this week. Oksana, Keith, wonderful to get your views to kick off the trading week, going into the opening bell about 8 minutes away. This from Andrew Hollenhorst, the City, a little bit earlier this morning. Essentially, the message from them is it will look like a soft landing until it doesn't. A true soft landing, they say, involves inflation slowing to 2% while the economy avoids recession. They go on to say some economists and Fed policymakers see this as the most likely economic scenario, but in our view, it is the least well supported by empirical and theoretical evidence. The latest from Citi a little bit earlier. Coming up, the morning calls, and later, looking for some calm. After that storm, Neuberger Berman's Ashok Bhatia joins us around the opening bell after 4 straight days of losses in the equity market. That conversation still ahead.
Bell is brought to you by Crypto.com, the world's fastest growing crypto app.
When you automate sales tax with Avalara, you don't have to worry about things like changing tax rates, exemption certificates, or filing returns.
Avalara.
Internet without malicious websites. Without malware-ridden files. Zen. Be more cyber zen. Get NordVPN. 76% of 23andMe health customers surveyed reported taking healthier actions because they know health isn't just a future state. Health happens now. Start your DNA-powered health journey today with personalized insights from 23andMe.
Change. It's the price of winning tomorrow. To adapt, you'll need trading technology that automates and scales. While our market-leading data reduces fragmentation between teams, we'll partner with you to define and deliver exactly what you need, helping you face change in ways no one else can. This is bigger thinking. This is Bloomberg for the sell side. Learn more at Bloomberg.com/sell-side.
Closing out things on last week with a 4-day losing streak on the S&P 500. Just going through my brain, I think that's the longest daily losing streak going back to something like May. Your equity market right now, on the equity market on the S&P, is positive by 0.3%. On the Nasdaq right now, positive by about 0.5. That's the equity market story. Let's get you some morning calls. Wells Fargo upgrading DraftKings to overweight. $37 price target, seeing a less competitive environment due to mounting consolidation. That stock is up by 2.3%. UBS upgrading Wayfair to buy, saying investors are overlooking an attractive valuation and favorable setup. And finally, Redburn downgrading American Airlines to neutral, expecting higher fuel prices and a competitive domestic market to serve as continuing headwinds. The stock is negative there by 0.5%. Coming up, seeking stability after the storm, Neuberger Berman's Ashok Bhatia joins us at the opening bell on where he's looking after the biggest weekly decline in the equity market since March, and a bond market that's been all over the place. Your opening bell just around the corner.
Countdown to the opening bell is brought to you by Crypto.com, the world's fastest growing crypto app.
The first time your sales reached 100K with GoDaddy was also the first time your profits left you speechless. At the counter or on the go, save 20% with the lowest transaction fees and keep more of what you make. Start saving today at GoDaddy.com.
Third kid? What if she likes playing golf?
It's expensive.
We're outlawing golf.
Wait, can I still play?
Since we work with Empower, we don't have to worry about planning for a third kid. You can still play golf. Sometimes.
Take control of your financial future.
You need new replacement windows, but you're just not sure if they're in the budget this year, right? I'm Brian Gary here with Ted Coons from Renew by Ensign, and he's here to talk about how to make window replacement more affordable.
Well, first, Brian, you don't have to do them all. You could just replace your worst windows first. Or another way to make them affordable is to change the style of window. For example, you could do a gliding window instead of a casement. We have a lot of ways to make window projects really affordable.
Compared to other window companies, you have a completely different business model.
Yeah, with other companies, there's just too many people involved in the process. There's the manufacturer, the seller, and then the installer, and then the customer. And if you call with a problem, that's when they say, oh, we're the manufacturer. You have to call the installer for that problem. Or vice versa. We're the full-service replacement window division of Andersen. With us, there's no passing the buck. At Renewal by Andersen, we sell, build, install, and warrant our windows and patio doors. So if there's ever an issue, we take full responsibility for it.
For 1 month only, Renewal by Andersen is having a sale. Save $325 on windows and save $879 on doors. Save an extra $200 on your entire project and get a free upgrade to our smart sunglass. Plus, pay nothing for a year. Our flash sale ends August 31st. Call 1-800-431-4141. That's 1-800-431-4141.
Impressions, allowing truthful, positive content to rise to the top. Don't you deserve to have more control over how you're represented online? Get your free reputation report card at reputationdefender.com or call 1-877-866-8555.
There's something about having that piece of paper. Some people think that's worth more than my skills.
I've run this place for 20 years, but I still need to prove that I'm more than what you see on paper.
So good they can't ignore you.
It's the way my mind works. I have a very mechanical brain.
Analytics and empathy. That's how I gain clients.
I am more. I'm more than who I am.
Coming off the back of a 4-day losing streak on the S&P 500, longest daily losing streak back to May, the biggest weekly loss back to March on the S&P, and trying to bounce here by 0.5% on the S&P. A similar bounce on the Nasdaq 100. Will it stick? The fate of the equity market this week in the hands, maybe, of the CPI data on Thursday. There's the opening bounce onto the board and get to the bond market. What a move last week. Monday through Thursday yields higher, then snapping back on Friday, then bouncing this morning and fading a touch. It's kind of been the journey of the last week or so. Up 3 basis points on a 10-year, 4.0682%. CPI Thursday, PPI on Friday. In the FX market, in the last 30 minutes, last hour, just about reclaiming 110 in the FX market. Through most of this morning, the dollar dominant, stronger against most of the majors in G10 at the moment in foreign exchange. That story turning more recently in the commodity market. Just briefly here, we're down 0.6%, down about 50 cents to $80.30. About 30 seconds into the session, we do advance. We snap that losing streak. Let's see if it sticks. Up 0.5% on the S&P, on the Nasdaq, a similar move. One stock to watch at the open, Tyson Foods, posting a quarterly loss and shutting down an additional 4 plants amid slumping demand and rising prices. The company CFO calling it a difficult decision, but the right choice for the long-term future of the company. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, Tyson shares absolutely plunging this morning, currently off by about 10-11% or so. After reporting pain across the board, to get into some of the numbers here, posted a loss of $417 million in this past quarter. That compares to a profit of $750 million just a year earlier. Revenue declined by an as-expected 2.6%, and third quarter sales also trailed. As you mentioned, in an effort to cut costs, going to shut down those 4 additional chicken facilities. A tough decision, according to the CFO. But the headwinds here are pretty tough, John. If you take a look at cattle supplies, they're tight. And then on the other side, you have a glut of chicken and pork. And to put some context there, the average pork price fell by more than 16% from a year earlier. Chicken prices down 5.5%. You add it all together, bad news for America's biggest meat company. You can see that in the shares, currently off by more than 10%.
Stock getting butchered. You like that, Katie?
Oh, gosh.
Katie, that was brutal. All right, we're down 10%. Katie, thank you. Warren Buffett, benefiting from a surge in short-term interest rates. The billionaire's firm Berkshire Hathaway running this. We continue to believe that maintaining ample liquidity is paramount, and we insist on safety over yield with respect to short-term investments. Shanali has more. Hey, Shanali.
Hey, John, you're looking at Berkshire faring better than expected, even though Warren Buffett himself said earlier this year that you could have a tough year when you look at Berkshire's operating segments. But when you have so much money, more than $147 billion, near a record cash hoard sitting around, surely that surge in short-term rates really helps out Berkshire Hathaway, as does a rebound here in insurance underwriting profits. Now, I want to actually turn a little bit to another corner of the market, from Warren Buffett to KKR. KKR. The reason being is private equity has been long one of those reasons that Warren Buffett has had so much of a hard time using that cash hoard. And this idea of using insurance, taking that float and reinvesting it is a big reason you've seen Apollo, KKR dive into that same trade. And you have KKR shares also rising on the day. If you think about the $140 billion that Warren Buffett has sitting on the sidelines, you look at KKR and the unused funds, the dry powder is $100 billion. Over at Blackstone, that number is about $200 billion. Across the private equity industry, it's $2.5 trillion. So among both of these companies, you have to wonder how long it will be before they can meaningfully start putting money to work with hundreds of billions of dollars just sitting on the sidelines.
Shonali, thank you. That's the latest for Berkshire Hathaway and the rest. Elon Musk, a step closer to his cage fight with Meta CEO Mark Zuckerberg, maybe. Musk tweets in the fight will be live streamed on X. Then on Threads, Mark Zuckerberg said, shouldn't we use a more reliable platform that can actually raise money for charity? Ed Ludlow has more. Morning, Ed.
And then the next development after that, Jonathan, is Elon Musk taking to X in a post, which basically means now that all bets are off in this proposed cage fight in the Octagon in Vegas. Musk is saying that he will have an MRI today on a historic neck and back injury that stems from a bout that he had in the sumo ring 8 years ago. And he shared a photo of this sumo bout and said that he was able to throw his Japanese counterpart. However, in the process, crushed his C5, C6 vertebrae. And they've been fused for a number of years with a titanium plate. He needs to investigate whether he gets that titanium plate tightened. So we don't know where we stand. As you know, Zuckerberg cast doubt on his own platform Threads that the fight would go ahead, because when Musk posed the challenge originally to Zuckerberg in June, Zuckerberg's response was, let's do it August 26th, and Musk has not responded to that. Dana White, the head of the UFC, has been involved, and as you know, he claims to have spoken to both parties who say to him that this fight is being taken seriously. That's where we stand. We'll continue to track it. I will be posting to Bloomberg's social media account shortly with the full details of the story. Big piece of breaking news, though, at the Open. Tesla, actually it's pared its early losses in the session, but CFO Zach Kirkhorn has stepped down. And this is actually a big surprise. He has stepped down as CFO effective August 4th. He will be replaced by Tesla's chief accounting officer, Vaibhav Taneja, but he will stay on for the rest of the year to help with the transition. You know, Zach Kirkhorn has been at the heart of everything that's been good for Tesla, frankly, in the last 4 years as CFO, since being named in 2019. He was a rookie then, an unknown quantity, but what he's done is basically brought regular profit to Tesla, done smart capital raises, and every investor and analyst I've spoken to has been a big fan of his in that time. So interesting news out of Tesla at the Open too.
Thanks for that, Ed. Some serious stuff. Tesla down by 0.9%. Elsewhere, Barbie is Warner Brothers' billion-dollar baby. Global ticket sales for the hit movie topping $1 billion over the weekend, becoming just the second movie to pass the mark this year, just behind the Super Mario Brothers movie released earlier in 2023. Abby has more. Hey, Abby.
Hey, John. And yeah, we do have Barbie joining not just Super Mario Brothers, but about 50 other films that have grossed more than $1 billion in global ticket sales, joining the likes of Titanic, Avatar, Jurassic Park, these real iconic films. So perhaps Barbie is on that trajectory. It certainly seems as though it is. And as you mentioned, it's just the second to do so this year. Confirmation came around 2 a.m. This morning from Warner Brothers. It happened yesterday in terms of surpassing $1 billion. Now, the stock is up about 8% since Barbie's release about 3 weeks ago, helped out by some of that Barbenheimer magic. A big accomplishment for sure for Greta Gerwig. This year, we have Warner Brothers, John, up 47%. The company, of course, merged last April. It's expected to be profitable in the fourth quarter. Relative to Mattel, up less on the year, up more than 10%. Today, though, Mattel up 1.8%. It's best day since July. The question will be whether or not Warner Brothers can give up some of the premium. Right now, it's trading at a huge premium to the group. It seems as though Barbie can help its numbers move in the right direction. I still have not seen this film, John, but I have had a couple people come up behind me and say, supposedly a big line in the movie, hey, Barbie.
I haven't seen it. I haven't seen it, but I will see it when it comes out on streaming. I just don't feel the need to go to the movie theatre and watch that just yet. About 7 or 8 minutes into the session, your equity market positive by 0.6%. Stocks are looking to snap a 4-day losing streak after recording its worst week going back to March. RBC's Laurie Calvasina says we're due for a pause.
We don't like where we are, sort of in the intermediate term. This just feels to me like a market, while I think everything has been deserved in terms of what we've done so far, it just feels like this market needs to stop, pause, have a little moment of digestion, and catch its breath.
This conversation with Neuberger Berman's Ashok Bhatia. Ashok, wonderful to catch up with you, sir. It always is. A theme of the morning so far, is it recession delayed or recession avoided?
Chug along at 2% types of growth levels. Inflation will fall slowly this year, and then there'll be a more accelerated fall in inflation next year. So I think, this is still something for the U.S. that looks broadly like a soft landing. It's something that's not going to result in a very sharp rise in default rates. It's going to be something that should bring some stability into interest rates. I think a bit of the challenge is we are seeing some divergences globally. While the U.S. is certainly looking like, a soft landing continues to develop, there's a bit more weakness in Europe, particularly in core Europe, where both, the consumer sector, the manufacturing sector are seeing some weaknesses. And then China is also struggling to get growth rates back up. So I think it has in the last 6 months gotten to be a little bit more of a mixed message globally on the growth front. But the U.S., everything we see still looks pretty consistent with a soft landing.
Domestically, that view on a soft landing, can you just explain to me, is that a view of a soft landing with inflation returning to 2 or a Federal Reserve just tolerating 3?
Well, make 2 points. I think it's a view that inflation can get back to 2%, but that is more of a 2024 event than anything near term. So it is, we see a path back to the 2% upper bound of core PCE that the Fed targets. So we don't think this is going to be something where the Fed is going to have to, change its target or something like that. I think, but the second point is that, the bond market is basically pricing this sort of trajectory. It's pricing, if you look at what's embedded for Fed tightening and then easing. The bond market's really saying in the U.S. that inflation will be, 0.2, 0.3 monthly prints this year before something more rapid next year that allows the Fed to ease maybe 100 basis points, in the first half of next year to keep the real policy rate pretty stable. That all seems pretty reasonable to us and can be a scenario that's not very disruptive for markets if it plays out like that.
You suggested that defaults may not be that bad. My words, not yours, but you can give me some more colour on that. We had a guest earlier on this hour, Oksana Aronoff of JP Morgan, who suggested, Ashok, there was a maturity wall out in 2025, that this market would begin to price 12 months out in early 2024. Why isn't that the way you look at things?
Well, that's absolutely the case. So, our base case is, default rates, and I'll just use the U.S., European high-yield markets. They were around 1.5% default rates last year. We think they'll be around 2 to 3%, this year and next year. So modest increase, but, compared to long-term averages, this is still a pretty benign environment. I think that point about the maturities increasing in 2025 and 2026, absolutely correct. We are seeing at the margin some, high-yield issuers where spreads are, pretty attractive, relatively low spreads. There is some movement to further extend those maturities. So it is possible if we get into, economic weakness next year that becomes a bigger issue. But, the flip side is that if growth continues to chug along at 2%, this can still be a relatively low default environment. I think the issues, we think the issues with, the credit markets, it's really not a fundamental issue. It's simply that, spreads are at the low end, tight end of ranges. So it's more to us a question of relative value across these markets more than there's a fundamental issue brewing in the credit markets.
Well, we all have access to this information. We can go through the individual maturity profiles of individual companies. Are you beginning to see any dispersion whatsoever appear within high yield?
Yeah, we are seeing some themes. I think we're seeing businesses that maybe are, rich in assets, but maybe a little lighter on cash flow, where 2 years ago the bond market would say, hey, this company's got a lot of assets. I may be a little less concerned about cash flow. That's one theme we're seeing pressure. We're seeing pressure in legacy businesses, so things where, they are structurally declining businesses or structurally challenged businesses. Zero rate environment, bond market was willing to maybe look past that a little bit more challenges there. We're seeing challenges in, floating rate structures where the interest impact has happened and, cash flow declining. In some of those cases, equity owners are putting in a little bit more capital to keep the business, moving forward. So the rise in interest rates is having some impacts, and obviously the financial system, in March was in the news. But would say these issues have been more manageable. They're not leading broadly to defaults, but to relative negative price performance in some areas of the bond market.
Another area of the bond market we've seen a challenge is just in the sovereign bond market in treasuries, not off the downgrade, Ashok, just off the additional supply we're now expecting. There's a ton of it this week. Do you think we're going to be able to absorb that additional supply with ease later this year, through this week and beyond?
Yeah, I think so. 2 points on this. I think first, this challenges to governments, it's well known, and it is coming. I mean, the amount that the U.S. Treasury is going to spend on interest expense in the next 10 years, or the Congress, it's going to triple. So these challenges, I think, are well known, or at least they should be well known, and they are coming, and it will result, we think, in long-term or intermediate-term pressure and long rates. But I think the second thing that's also been brewing on this in the last week has been what's happened in global markets. This has coincided with the Bank of Japan relaxing its target for 10-year yields. We've seen steepening in that curve. We've also seen steepening in the European curves. So the U.S., we don't live in an island or isolated bond market, and steepening pressure from those two markets also bleeds into our market, and we think that's been one thing that's been going on as well as the supply concerns.
Bond market's fascinating right now. Ashok, thank you. Appreciate the time, as always. Ashok Badia there of Neuberger Berman on fixed income, both credit and sovereigns. On the sovereign debt market screen right now for treasuries, on my Bloomberg, yields are higher by about 3 basis points on a 10-year, just north of 4%. Coming up on the program, Apple looking to bounce back after its biggest one-day drop of the year.
Longer term, the health of Apple remains very good. But as far as kind of what they're having to navigate through right now in terms of some of the challenges on the hardware side of things, that's something that they've been doing here for the last couple of quarters, and they're going to need to continue to contend with, at least in the near term.
That conversation up next.
The opening bell is brought to you by Crypto.com, the world's fastest growing crypto app.
This thing, it's making you get an ice bath again.
What do you mean? These straps are mind-blowing. They collect hundreds of data points like HRV and REM sleep, so you know all you need for recovery. And you are? I'm an investor in Invesco QQQ, a fund that gives me access to NASDAQ 100 innovations like wearable training optimization tech.
How long
I'm done.
Become an agent of innovation with Invesco QQQ.
I'm okay.
Before investing, carefully read and consider fund objectives, risk, charges, expenses, and more in prospectus at Invesco.com.
Today is looking deeper at our ESG plans, then putting out a supply chain fire, then getting a last-minute briefing on cybersecurity. My priorities don't just shift, they shift by the hour. That's why I need Aon. Their combination of advanced analytics and expert insight keeps me up to speed and ready for my next move. Better decisions. Aon.
What if you can make analyzing a big bank's data no big deal?
Go on.
Well, what if you partner with IBM and Red Hat, use a hybrid cloud solution to connect data across clouds, then analyze all that data with Watson?
Okay, but this needs to meet our
security standards? Yep.
Compliance standards?
Mm-hmm.
So they get the insights they need.
Yep.
In real time.
Check.
To make quick decisions.
Check. And check. That's the solution IBM and a global bank create. What will you create? IBM. Let's create.
Pay over $100 a month for cable when it's half the cost for Fubo TV. Get all the channels you want on the only live TV streaming service rated #1 in customer satisfaction by J.D. Power. Try free at FuboTV.com.
If you're watching this Gerber Life Guaranteed Life Insurance commercial, there's a good chance that you're alive. And if you're not, well, this may not be of interest to you. Now, I know what you're thinking. Life insurance? I'm going to live forever. Death is what happens to other people. Well, for the sake of argument, let's assume you're wrong, and that someday you won't be watching TV anymore. I know, it's not easy to talk about, so I'll do the talking. If you're 50 plus and alive, you can apply for Gerber Life Guaranteed Life Insurance with guaranteed acceptance, regardless of your health. And since this life insurance aid, you don't have to get a medical exam. In fact, you don't even have to fill out a health questionnaire. For a first call 800-600-8948. Then when you stop, if you stop watching TV, your family can use the insurance money to help cover your final expenses or anything else. For a free quote, call today, 800-600-8948. Your kids already inherited your ears, allergies, and questionable singing voice. Don't make them inherit your final expense tab, too.
This is Bloomberg's The Open. I'm Abigail Doolittle, and you're looking at a live shot of the principal room. Coming up, ARC Investment Management CEO Kathy Wood. That conversation at 1 p.m. Eastern, 6 p.m. London. This is Bloomberg.
The biggest positive takeaway from this earnings call was the services side of things, and I think most polls would point to that. Longer term, the health of Apple remains very good, but as far as kind of what they're having to navigate through right now in terms of some of the challenges on the hardware side of things, that's something that they've been doing here for the last couple of quarters, and they're going to need to continue to contend with, at least in the near term.
5-day losing streak for Apple, longest daily losing streak of the year so far. CFRA's Angelo Zeno expecting Apple to rebound from its worst week of the year. Shares falling for a 5th consecutive session after losing its grip on a $3 trillion market cap. All of this ahead of the iPhone 15 launch in less than 6 weeks' time. Dan Ives at Wedbush saying this: I believe this is just a pause. Selling Apple into the iPhone 15 cycle, in my opinion, is leaving the Super Bowl at half-time. Let's get to the team coverage. Ed Ludlow, banker with us alongside Bloomberg's Anurag Rana over in Chicago. Anurag, I want to come to you. Is that iPhone 15 going to solve all of their problems?
See, for Apple, I think one of the things people need to really understand that the next version of iPhone just accelerates the refresh cycle for a little bit. It doesn't really change the dynamics of the company. Now, the way we have always thought about this is an average iPhone user changes their iPhone at about 3.6 years. That doesn't change up, it goes up and down, but it's been very consistent for the last several years. So from our side, iPhone 15 is going to give a push. All the stuff that we are seeing, the lack of pressure in buying right now, we should see that in the fourth quarter or the December quarter, assuming we don't get into any supply chain problems. So I'm fairly optimistic that it's going to be fine.
And this stock, struggling just a little bit. Great year-to-date gains, up something like 40% before today. We trimmed those on Friday, but this morning, down another 1.6%.
Yeah, and as you said, the fifth consecutive straight day of declines. You have to go back to December for the last time this stock was under that much pressure. It's interesting what Anurag said, because you have to match the backward-looking comments of executives on the call last week with their forward-looking comments. Luca Maestri, the CFO, said that in the US, the smartphone market had 2 quarters of declines, and Tim Cook pinned some of the bigger macro weakness on that US market, contrasting it with China and India. Here's what we know. Here are the specifics that Bloomberg's reported about the iPhone 15. Should go on sale September 22nd. According to sources. That is after an event which we believe is planned for September 12th or 13th. It's interesting because if it does launch September 22nd, week of sales in the fiscal fourth quarter ending in September, you're also interestingly lapping some comps with the period a year ago where, remember, the iPhone 14 Pro and 14 Pro Max were impacted by the second COVID wave in China, Foxconn's facility. And remember the story, John, I was on the show every day with you talking about this. The demand was for the higher-end Pro handsets on the 14, but they couldn't make them. They did not have the production disruption in the iPhone 14 standard version, but there was no demand there. In terms of what we know, the Pro model for the 15 is going to have a border that's about 1/3 thinner around the display, a titanium frame as opposed to a stainless steel frame, better camera, USB-C charging port, and a faster processor. Does the tech drive the upgrade cycle? And I think that's where we have some questions.
Is that enough to get us to upgrade? Ed, Anurag, to the two of you, thank you. No doubt we'll be staying on top of this story through the next couple of weeks, going into the launch, if it is indeed in the back end of September. Let's get you some sector price action. We can do that now with Abby. Hey, Abby.
Hey, John. We have a very strong sector composition on this Monday. The overall gain for the S&P 500 up about 0.5%, but 10 of the 11 sectors are higher, led by communication services being helped out by the likes of Alphabet and some of those other mega cap tech stocks. Financials doing well, too, up 0.9%. Of course, Berkshire Hathaway put up that great quarter. Not doing so well, though. Consumer discretionary down slightly, so we can't really even talk too much about it. And same deal with energy. Digging into those financials just a little bit more, we get some real strength for the banks. And of course, we do have yields modestly higher, but last week a big backup there is the financial sector up about 0.8%. Berkshire Hathaway really outperforming JP Morgan, Chase, and MasterCard doing well too, John.
A lift for the financials. Abby, thank you. Coming up next, your trading diary.
The Principal Room, brought to you by Principal Asset Management. Specialized expertise, unique perspectives, optimized results. Principal Asset Management, actively invested. Learn more at principalam.com.
Taking an active approach to investing means looking at asset management through a different lens. One with a clear focus on our clients. Throughout market cycles, teams of specialists at Principal Asset Management have applied local insights and global perspectives to optimize results. This clear point of view allows us to identify the most compelling opportunities now, while positioning for what's next. Principal Asset Management, actively invested.
When you're a small business owner, there's no such thing as 9 to 5. Days are longer, and business hours, well, they're anything but predictable, especially when you have clients like ours. When I considered payroll providers for my business, I looked for a solution that fit into my busy schedule. Sure Payroll makes running payroll easy, and its U.S.-based customer service is there for me when I have questions, after hours, and even Saturdays.
Visit surepayroll.com/switch and get up to 6 months free and find out what makes us different. Because small business is our business.
The biggest ideas inspire new ones. 30 years ago, State Street created an ETF that inspired the world to invest differently. It still does. What can you do with SPY?
Private market alternatives help you grow portfolio by up to 40%. Meet Yield Street, the leading private market investment platform with 10 highly vetted asset classes. Diversify with alternatives. Open an account at yieldstreet.com.
Attempting to bounce, but it's not convincing, is it? About 25 minutes into the session, the S&P 500 just about positive by 0.5%. The Nasdaq lags just a little bit. We're positive there on the Nasdaq 100 by 0.46%. That's the price action. Here's the trading diary. Your week ahead. Philadelphia Fed President Patrick Harker, Richmond Fed President Tom Barkin. They'll be speaking through the next 24 hours. Plus, earnings from UPS and Rivian, followed by more results from Disney after the closing bell on Wednesday. Thursday, it's the main event. It's CPI. Thursday morning, you'll get some jobless claims data as well. And finally, we round out the week on Friday with PPI and UMich consumer sentiment survey data. From New York, that rounds out the morning for me. Thank you for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
76% of 23andMe Health customers surveyed reported taking healthier actions because they know health isn't just a future state. Health happens now. Start your DNA-powered health journey today with personalized insights from 23andMe. Instead of merely making money, why not consider building money? Bellpoint OZ, the first publicly traded Opportunity Zone Fund. Our unique fund targets tax-advantaged real estate investments designed to defer and eliminate your tax liability. Download the white paper at bellpointblue.com. Bellpoint OZ,
Build it.
Optimum Business customers love their secure internet. Gene says, I feel secure using Optimum. Get internet with plans starting at $60 a month with a mobile discount. Switch now and get up to $200 back. Call or go to optimum.com/business.
I have active psoriatic arthritis, but with Skyrizi to treat my skin and joints, I'm feeling this no more. Along with clearer skin, Skyrizi helps me move with less joint pain, stiffness, swelling, and fatigue. And it's just 4 doses a year after 2 starter doses.
Serious allergic reactions and an increased risk of infections or a lower ability to fight them may occur. Tell your doctor if you have an infection or symptoms, had a vaccine, or plan to.
There's nothing like clearer skin and better movement, and that means everything. Ask your doctor about Skyrizi today. Learn how AbbVie could help you save.
Good morning, and thank you so much for waking up with us here on Mornings on News 12.
Start your day with the news that puts New Jersey first.
We're live in the Toucher this morning.
First, with stories about you, your family, your neighborhood.
And East Brunswick this morning.
First, with your hyper-local traffic and weather.
Chance of severe weather today from Union to Thompson.
Watch the only 24-hour news station dedicated to New Jersey news, beginning at 5 a.m.
Only on News 12 New Jersey.
Replacing or repairing your roof, you want it done by the best. That's exactly who Allied Brothers Home Corporation is. We provide a wide variety of roofing solutions, from repairs to full roof replacements.
At Bassett.com.
For the ones finding new ways to ensure the job always gets done. For the ones wearing many hats. For the ones who are hands-on, even from far away. And the ones keeping business moving forward. We are Grainger, offering professional-grade industrial supplies, plus real-time product availability and access to experts ready to answer your toughest questions. Call, click Grainger.com, or just stop by. Grainger, for the ones who get it done.
Telling the girls about my Alzheimer's diagnosis was really hard. Early detection gave us time to adapt together.
If you or your family are noticing changes, it could be Alzheimer's. Talk about seeing a doctor together.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
Into the U.S. trading day, Monday, August 7th. Here are the top market stories that we're following for you at the hour. Your earnings takeaway. JP Morgan says the risk reward for stocks is unappealing as second quarter earnings slow to a trickle. And then we got your rate takeaway. Yields claw higher, hedge funds load up on shorts while asset managers buy the dip. And then we're going to get your deal takeaway. KKR earnings beat estimates despite profit falling 23%. Stocks up. We're going to look at the deal-making slump. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. We say takeaway because we're going to try and find a takeaway today, but I have to be honest, it's hard to find an overarching through line right now. I feel like we're all kind of settling after last week's yield explosion.
Yeah, waiting to see exactly what CPI delivers later on this week. Waiting and seeing how the Fed is reacting to what has happened. We'll get a lot of Fed speak coming up. As you say, though, the earnings story kind of peters out a little bit over the next few days. And that takes us back to the macro narrative, which has dominated. I have to ask, though, how was Oklahoma? Did the hat make it back okay?
Okay, so I almost left the hat on the plane, but I didn't.
I heard.
I mean, it was a big deal. I didn't. The hat did make it home. My daughter tried to steal my hat, and I was like, no, that is mommy's. And so now I have a cowboy hat. I'm still trying to figure out, like, the thingy ding.
The whole look.
Like this.
I was wondering about this.
Yeah.
Basically, I figured that Alex now has to buy an entire outfit to match the hat. Top down. This is a top-down market. You start at the top, you work your way down.
Yeah. And bottoms up, I need the cowboy boots now. But I think ankle boots. You don't want to like overdo it in New York, but I think if we get the ankle boots, I think that will like help really balance out the top and the bottom.
Okay. I think the top-down bit is germane here because I still think this is a top-down market. I'm going to segue into talking about earnings here.
That was actually really impressive.
It is a top-down market as I trip on the floor. It is a top-down market. We're getting back to macro. You and I have been talking about earnings over the last few days. What I'm trying to figure out is, do earnings matter? I know I'm going to get some hate mail from analysts here, but I'm not sure they do above a single stock level. Look, what has been happening? Thus far this year, US stocks, massive outperformance. And we're heading back into a story where macro is going to matter.
You guys are talking about a soft landing over there. It doesn't feel like we're having the same conversation over here in Europe. I thought the European earnings season was going to be really horrible. The last week has kind of rescued it, and I thought that was going to confirm that big discount that we've got to US stocks. And I'm now kind of wondering where we are. Are we in a position where European stocks can improve from here? I'm really struggling with that narrative if the US is talking about a soft landing and Europe isn't. That does matter.
But what also people are pointing out here in the U.S. is that it's still a landing. Even if it's soft, we're still going to land. So does that provide some speed bumps? You are seeing any earnings outperformance is not necessarily being reflected in after stock performance. So like, yeah, you might beat, but maybe that's already priced in. So maybe we've already done the job.
But if we get that slowdown, Europe is much more cyclical. And it's really interesting. There's an MLife survey out there as well that European equity investors see the US as being in a bubble. US investors don't see the US being in a bubble. So that kind of home bias is still very much in action here at the moment. Our question of the day is a fairly straightforward one. We're coming to the end of earnings season. Alex pointed that out. Do earnings prove US exceptionalism? Thus far, this year has proved US exceptionalism. Jess Menton, Abigail Doolittle joining us now to discuss. Jess, is the US exceptional?
Things. Obviously, this is the third consecutive quarter where you see an earnings contraction in the S&P 500. But if you look underneath the hood, Bloomberg Intelligence actually has a lot of data on this. When you extract energy from S&P 500 earnings, that is what is really clouding the outlook there. Because last year, they were the ones that had a brighter outlook, obviously with the correlation to energy prices and commodity prices. But the other effect is happening this year where it's masking improvement and especially cyclical corners of the market and sectors when you're thinking about discretionary, also industrial. Those have a much brighter outlook and are actually, if you're looking at the earnings estimate revisions, those are getting marked up the most a year from now.
And industrial is a good point because that also has a fiscal impulse there, which will get you in just a sec. So Abigail, do earnings show U.S. exceptionalism then when it comes to flows?
I think that it might be hard to say that U.S. earnings at this point show U.S. exceptionalism. It's certainly an interesting question when we're taking a look at the earnings season that has, for the most part, come in. 80% of the companies have beat on the bottom line, so that shows the propensity of management teams to be able to manage well. Sales have been decent too, but the beat has been closer to 55%, so there's a pretty big spread there. Something, though, that's important to keep in mind is the idea that we are in an earnings recession on a year-over-year basis, so there is some weakness there, and there's been so much talk about, this recession to come. One point that I would make around a recession is the old, or maybe the current definition of a recession, 2 quarters of down GDP. Well, that actually happened last year, so the fact that we kind of made it through that, we do have a little bit of an earnings recession, but we're trucking along, suggests, I think that there's some strength here, and I think that the fact that you have U.S. stocks up so much more, that's probably the point that investors are looking at more so in terms of relative to the actual earnings.
Yeah, I agree. It's a macro-driven market, Abigail, and that's been the narrative thus far this year. That's why we've seen the outperformance of the U.S. Plus, you throw in a little bit of AI just to spice things up, and that makes things look even better as well. So as we look forward and try and figure out what happens next, if we do hit Europe harder than the United States, Europe has much more cyclicality. It has that exposure. Does that now work against Europe in a much bigger fashion as we head the US a little bit more there as well? And when it growth stocks, if growth is scarce, don't you want to own those stocks that have it? And doesn't that mean a continuation of U.S. big tech?
So many questions, so I'm going to try to remember what you just asked, guys.
Yeah.
So first of all, I would say that
you just said you talk too much.
I would say I don't know that this year's stock rally for the U.S. is all macro. I think that you do have, against the backdrop of what did appear to be a recession last year, horrible stock performance, and then this outperformance for stocks. Companies have, again, 80% are beating on the bottom line and 55% on the top. So while there is an earnings recession, companies are doing okay with what they have. Relative to Europe, as you know, the stock 600 is underperforming the U.S., up about 8%, the S&P 500 up about 20% on the year. You might be able to make the case, just strictly from an investment standpoint, that Europe is going to have some catch-up. So if there is some softness for the economy ahead, the global economy, you could see investors move more toward the places that have underperformed, but that's only if it's not a falling off the cliff type of a situation. And then relative to growth, yeah, absolutely. I think that if there's high quality companies that have growth and have good balance sheets, you're going to want to go there. Google, Alphabet's a good example. Right now we have Apple down for a 5th day in a row. Their growth is not there. They have that balance sheet, but Alphabet, you have solid growth. I think it was 11% or something like that, and the stock has been rewarded since that earnings report.
So, Guy, I think that this so begs a question in terms of how you price in 2024, and we're talking about the fiscal impulse. I mean, Mike Wilson of Morgan Stanley, no surprise, still somewhat bearish, saying that, look, the fiscal impulse helps this year, and it helped avoid a recession, but that's not going to be the same next year, and that's when you're going to see things wind up getting hit. And you haven't seen GDP estimates for next year increase, so do you have to start pricing that in a little bit negatively, and that's going to be a big change versus, say, Europe, Guy?
It is the cost of no recession, slower growth and higher rates. I think that is a question that I think the market's going to have to grapple with. And coming back to Europe, that's not a great environment for Europe. Quite interest rate sensitive, cyclically adjusted. Cyclically, the market is more, it has more exposure. So I think none of that bodes particularly well for Europe. But to Abigail's point, Europe is cheap. Let's just throw this chart up here. Look at that. Look, that has been the discount that we've seen widening out year to date. Look at the story. It's over the last few years. It's been widening out, and this year to date, it has widened out massively. It is starting to stabilize a little bit, but I think the last week has been really important for Europe. It's rescued the earnings season. I think if the earnings season had carried on the way that it started, I think that discount may have widened even more.
But, you know, Jess, what they always say is just because something's cheap doesn't mean you buy it.
Exactly. And really, when you're looking ahead, when you're talking about energy, when you extract that from the S&P 500, earnings growth is actually supposed to continue in the second half of the year. And Gina Martin-Adams, she looks at how, if you look back to the second quarter of last year, that's when the actual earnings recession started, when you're taking energy out of the S&P 500. So that's going to be key. But you are seeing U.S. companies reinvest in CapEx more so than they have been instead of as much into buybacks. So that's showing you some potentially brighter signs as far as what CEOs think of the outlook for the economy. But can that continue? Even though we have more than 80% of companies in the S&P 500 reporting, we still have retailers starting with Walmart next week, and then we still have NVIDIA on the 23rd. So that's going to be key to see how they report.
That's right. And Morgan Stanley also saying, hey, NVIDIA's already done it. They're in the later innings now of the bull market cycle there. All right, guys. Hey, thanks a lot. Thanks for setting us up. It's going to be an interesting week. Just mentioned Abigail Diddle. Thank you very much. So coming up, more on our question of the day. Do earnings prove U.S. exceptionalism? Rebecca Patterson, former chief investment strategist at Bridgewater, joins us next with her view. This is Bloomberg.
Hi, I'm Mr. Wonderful. If you own a business and have employees, you need to check out the ERC program at wondertrust.com. There's money waiting for you. I did, which is why I have time to tend to my precious little trees. You're such a good boy.
Constant Contact delivers the marketing tools your small business small stand tall.
This is a keepsake frame. This is actually a photo from my wedding. I'm Adam Weiss, founder and CEO of Keepsake, a mobile app that makes it easy to have your photos printed, framed, and shipped to your doorstep. You just choose a photo that you love, you can preview it in over 100 frames, and in a couple of days, you're going to receive your photo in a beautiful, hand-made frame. So if you've got a special photo on your phone, install the free Keepsake app. We would love a chance to frame it.
You can't buy great conversations or moments that matter, but you can invest in them. At T. Rowe Price, our strategic investing approach can help you build the future you imagine. T. Rowe Price, invest with confidence.
He snores like an angry rhino.
I've never heard an angry rhino.
Maybe I hear one every night. Every night.
Okay, I'll work on that.
Say
Save up to $500 on the new Sleep Number smart bed, plus free home delivery when you add an adjustable base. Shop now only at Sleep Number.
I supported raising the federal funds rate at our July meeting, and I expect that additional increases will likely be needed to lower inflation to the FOMC's goal. I'll be looking for evidence that inflation is on a consistent and meaningful downward path as I consider whether further increases in the federal funds rate will be needed and how long the federal funds rate will need to remain at a sufficiently restrictive level.
That was Federal Reserve Governor Michelle Bowman speaking earlier today. So that's sort of the macro backdrop, and then we also wind up having earnings. And the trade today seems to be by a little bit of equities. You're still selling the bond market, though. Question of the day, do earnings prove U.S. exceptionalism? That's our starting point here with Rebecca Patterson, a former chief investment strategist over at Bridgewater. Short term, do U.S. earnings show U.S. exceptionalism?
Well, this is the great conundrum right now because the consumer we know is strong. Tight labor markets, incomes are growing faster than inflation now. And so that's supporting earnings and dominating, even though the Fed is continuing to remove liquidity. And as Michelle Bowman just said in that clip, they're not done yet. So for now, I think that the consumer is creating that U.S. exceptionalism, and that's dominating the Fed. We'll see if it continues. When does the consumer pull back and how much?
Rebecca, good morning. It's Guy. Standing over here in London, we've watched your conversations over there regarding a soft landing with envy. It doesn't feel like we're going to have a soft landing over here. How critical is that soft landing narrative to whether or not you stay invested in the United States or shift and look at Europe? Europe is definitely cheap right now from an equity point of view. We may not have the soft landing, and Europe feels very cyclical.
No, I think I take your points and I agree with them. I think for Europe to outperform the U.S., you have the valuation discount already, but you don't have that growth catalyst. And so where are you going to get that growth from? Late last year till spring this year, Europe did outperform, and it got that catalyst, I think, primarily from China and the expectation that those close trade links would boost Europe as part of that China reopening. Now, as China has fizzled, Europe has also lost some momentum. So where does the growth come from? I don't see China later this month after their beach summit that they have every year coming out with some new huge demand side catalyst, and I think that's what's needed. So without that and without something else happening in Europe to boost demand significantly, it's hard for me to see capital leaving the U.S. despite the valuations and actively choosing to go to Europe.
Okay, so does capital move, though, from equities to the bond market still, particularly the deluge of auctions we're going to get this week?
Yeah, last week was so fascinating for the bond market. Your point on the auctions and all the issuance, Treasury definitely surprising the market on the upside in terms of how much supply is coming online. And then questions about will demand meet supply given the downgrade from Fitch. And then Japan, Japan's been a huge buyer of treasuries and foreign assets in general over the last decade plus, with yields finally starting to drift higher there. Maybe some incremental demand goes away. So I think there is a risk that bond yields could stay around these levels, maybe climb a little further in the short term. But with the level of yields being more attractive and with people looking at a soft landing, huge gains year to date in the equity market, I think you are still going to see some demand. The question is just where do those match up? Are they at current levels? Is it enough to bring yields lower? But, repeating the highs of around 4.25 we saw last year, possible. It wouldn't be my base case.
Rebecca, in that kind of scenario, the Fed is likely to keep rates elevated for quite a long period of time. Is that longer, higher environment fully absorbed yet by most investors, do you think? What kind of a rates paradigm do you think most people are operating with for 2024?
Yeah, I think the consensus is that the Fed is going to start cutting and cutting significantly next year. I think that's a big part of the reason you're seeing consensus predict a big pop in earnings growth, not just in the U.S., but globally. You see that baked into Euro stocks as well, thinking that the Fed could cut, other central banks could follow. And what I'm wrestling with is how much can the Fed ease next year if inflation is still above its 2% target. Now, John Williams, the president of the New York Fed, in the interview today in the New York Times, suggested that they could cut rates because they don't want real inflation-adjusted interest rates too restrictive too long.
But how much cutting are we going to get? Is it going to be as much as is priced in? It's hard for me to see that. And then you think this year was hard for the Fed. Next year, presidential election, right? So if the Fed is easing interest rates before it hits target, even if their rationale is very sound, they are going to get allegations of political bias, that they're trying to juice the economy to help the incumbent. I can see the headline coming now.
Yeah, fair enough. But at the same time, though, there is warnings of the fiscal impulse is going to slow next year, and that we're just borrowing growth this year from next year in terms of the fiscal spend.
Well, I take your point. I mean, we are seeing a bigger deficit this year. We are seeing all that money put forward by the CHIPS Act and the IRA, et cetera, flowing through. What we've seen historically from those fiscal impulses is it takes years to get that money into the ground.
Right.
Just the process of getting cities, states, companies to put in the requests for the money, getting the money, then actually investing the money, it takes years. So while the fiscal impulse might be reduced next year at the margin, I don't think it's black and white. And as was said in the interview just before me, you are seeing companies put more money into CapEx, and that tends to have a bit of a long lag as well, blowing through the economy. So I do think we're going to have a much slower economy next year. I still think a mild recession is very possible. All the soft landing hope, while it's plausible, it is getting priced in. So I think some caution as we go into the second half of this year, we're in it now, I guess, into the fall, is very warranted.
Rebecca, do you think a hard landing is now off the table?
I think for a hard landing, we probably need to see another pop in inflation that's really jarring to the market. You have to keep an eye on gasoline prices in the United States. If we go back above $4 a gallon, that could be a big psychological hit to consumer confidence, possibly spending. Obviously, there's always the idiosyncratic shock that could come. More banks getting in trouble, perhaps certain parts of the private equity market getting in trouble. So things like that are always possible and could easily be that, the nail in the coffin that causes a hard landing. But without something like that at this point, we are getting more and more data every month showing that the labor market is moderating primarily from job openings coming down, not layoffs. And that means people still have their jobs, they have their incomes, they can spend. That reduces the risk of the hard landing at the margin.
So it was a kind of maybe sort of yes.
There's a window for a soft landing.
And we could see it.
If I had to put a number on it, I'd probably be like 60% mild recession, 40% soft landing personally. I still think a mild recession is more likely. But I do think there is a path to a soft landing. Again, the Fed, man, I don't envy them right now. When do you start taking your foot off the brake? How quickly? And then if they take it off too quickly, inflation pops back up, then they have a repeat of the 70s where they have to raise rates again, that stop-go cycle. If you think about something that'll hurt confidence, that's it.
Yeah, and then we've already seen commodity prices start to pick up again, particularly. We'll talk about that in just a moment as well. Always good to catch up with you. Thank you so much, Rebecca. We appreciate it. Rebecca Patterson, a former chief investment strategist over at Bridgewater. All right, still ahead. Apparently there's a cage fight. We're waiting for it. Two of the richest men in the world. You got Elon Musk says his match against Zuckerberg's on hold. He's got to get his fact checked out. MRI. Health's important. We'll have the details next. This is Bloomberg.
If your roof is showing danger signs like streaks or raised shingles, it could be trouble. And a new roof could cost $10,000, $15,000, or $20,000. Introducing RoofMax, the first professional and affordable roofing treatment that is scientifically proven to strengthen and extend the life of your roof. With RoofMax, you'll have the protection of a brand new roof and save thousands. RoofMax's skilled technicians apply a safe, effective, and affordable natural treatment. And within hours, you have a roof that performs like a new roof. RoofMax's exclusive treatment resaturates old, dried shingles with a natural, bio-friendly formula that quickly restores flexibility and water-repelling protection guaranteed. Look, this is a 17-year-old asphalt shingle. It literally disintegrates. But here's an identical shingle that we treated with RoofMax's proven formula. It passed rigorous flexibility testing from The Ohio State University as a new shingle. So a RoofMax roof can also pass a home inspection if you're getting ready to sell or for insurance, saving you money. RoofMax has treated over 50 million square feet of roofs all across America. And just check out our website for the thousands of 5-star reviews.
I was skeptical at first with the existing condition of the roofs. We were having high winds and shingles were blowing off the roofs continually. But You know, 5 years later, after the application, the roofs look great, and we have no issues with any shingles blowing off the roof.
Keep your family safe and happy with RoofMax. Call or go online now for a comprehensive leak threat analysis and roof maintenance tune-up. A $539 value free. RoofMax. More life, less money, guaranteed.
Call 1-800-519-9316. That's 1-800-519-9316. Or log on to roofmax.com. Call 1-800-519-9316 now.
It is 22 past 7 on the West Coast. We want to get to the startup. Oh, look at that beautiful sunrise. Top tech stories from the Bay Area and beyond. As Silicon Valley starts this beautiful morning. Joining us now, Bloomberg Technology co-host Ed Ludlow. Ed, we're like London right now. We are rainy and gross, and it's horrible. It looks nice there. Are the clouds clearing for an Elon Musk, Mark Zuckerberg cage match? Do we look forward to this?
You know, everyone is talking about a potential cage match between Elon Musk and Mark Zuckerberg. What we heard over the weekend has cast a lot of doubt over it. All bets are off. Musk posted on X, the platform formerly known as Twitter, that he's having an MRI today, looking at a historic injury in his neck, in his back, that might require surgery. And if you're going to enter the octagon, no matter at what level, and you have a spine injury, I think that casts some doubt over things.
Ed, what is the real objective here? I've yet to really figure that one out. Is it that they're trying to... Are they just trying to amp up competition between the two of them? Between their two companies? Does this serve a greater purpose other than just having a little bit of fun?
Free PR.
It puts the spotlight on two platforms that are new, growing, going through a transition. You know, Zuckerberg can genuinely claim to have a long-standing interest in mixed martial arts, jiu-jitsu. He's regularly shared posts on his social media of him training, but that rivalry's amped up since the launch of Threads, and both have kind of talked about that. It's interesting because Musk's injury, he posted over the weekend and shared a photo, stems from a round he did in the sumo ring 8 years ago. He shared a photo of him fighting a sumo wrestler. He said in that fight he was able to throw his counterpart, but in the process damaged his C5, C6 vertebrae. And they're fused by a titanium plate that he says now needs to be tightened. So, you know, we want this to happen. Musk loves the spectacle, right? He loves creating a buzz online. What I do not know, I don't have a concrete answer for you, is how long-standing his interest in the martial arts is.
I really don't know where to go from here. All I know is that you're fusing again your vertebrae. That's not a good sign. You lose a lot of flexibility and extension, but that's just my Pilates brain talking. Can we go to AI for a second? Morgan Stanley had a note out that said that the NVIDIA was sort of in late cycle, calling again that we're looking at a proxy as a bubble, that maybe we're near the top. I mean, is this what we're going to hear again as we head into earnings?
Yeah, and it's so interesting because actually everyone's been really consistent on Bloomberg Technology that for a long time NVIDIA was the only pure play way of investing in AI through the public markets. But what we've learned about is actually that's not true. That yes, a GPU, specifically the H100s or A100s that NVIDIA makes, are important in the training of large language models, but very big ones. And, you know, if you speak to Intel or AMD, other chip makers, they will say, well, hold on, we offer either GPUs or even CPUs that are needed. Again, think about Micron. They are makers of DRAM and NAND memory chips. Data still needs storage, and so we're learning from the chip perspective that there are other investments that you can make, and the school of thought's changing. That as AI becomes more democratized and is more accessible, benefit.
Ed Ludlow with a ringside seat on what is happening in the technology world. Thank you very much indeed. Palantir is coming out a little bit later on. I know that Ed and the team will be talking about all of this, Bloomberg Technology, in around 90 minutes' time. Up next, commodities.
You automate sales tax with Avalara. You don't have to worry about things like changing tax rates or filing returns.
Avalara.
CFOs need technologies like generative AI to do more with less. There are people who are skeptical about the applicability of AI. Trust me, they're going to be proven wrong. Only 38% of the CFOs actually believe that the excels in planning and executing strategy. AI can help by automating day-to-day operations and releasing capacity to be focused on strategic activities.
You need new replacement windows, but you're just not sure if they're in the budget this year, right? I'm Brian Gary here with Ted Coons from Renewal by Anderson, and he's here to talk about how to make window replacement more affordable.
Well, first, Brian, you don't have to do them all. You could just replace your worst windows first. Or another way to make them affordable is to change the style of the window. For example, you could do a gliding window instead of a casement. We have a lot of ways to make window projects really affordable.
Compared to other window companies, you have a completely different business model.
Yeah, with other companies, there's just too many people involved in the process. There's the manufacturer, the seller, and then the installer, and then the customer. And if you call with a problem, that's when they say, oh, we're the manufacturer. You have to call the installer for that problem, or vice versa. We're the full-service replacement window division of Anderson. With us, there's no passing the buck. At Renewal by Anderson, we sell, build, install, and warrant our windows and patio doors. So if there's ever an issue, we take full responsibility for it.
For 1 month only, Renewal by Anderson is having a sale. Save $325 on windows and save $879 on doors. Save an extra $200 on your entire project and get a free upgrade to our smart sunglass. Plus, pay nothing for a year. Our flash sale ends August 31st. Call 1-800-431-4141. That's 1-800-431-4141.
At Walmart. False or misleading search results can negatively impact your life. A bad online reputation can put you at significant risk of losing job opportunities or new customers. Reputation Defender helps clean up your search results, wiping away negative first impressions, allowing truthful, positive content to rise to the top. Don't you deserve to have more control over how you're represented online? Get your free reputation report card at reputationdefender.com or call 1-877-866-8555.
I pay over $100 a month for cable when it's half the cost for Fubo TV. Get all the channels you want on the only live TV streaming service rated #1 in customer satisfaction by J.D. Power. Try free at FuboTV.com.
We're about an hour into the U.S. trading session after falling the most last week since early March. The same deal for the NASDAQ 100. The worst week last week since early March. Today up about 0.5%. So not huge gains, but again, a little bit of strength creeping back into the market despite the fact that we have yields higher. That 10-year yield popping slightly. And then the VIX, it's coming off, but it's still relatively elevated to where it's been for much of this year, closer to a 13 or 14 handle, right now at a 16 handle. Now, one stock not helping out the markets and certainly not helping out last week, Apple now down for a 5th day in a row. This is the first time we've seen this since December of last year, down about 9% over this time period, also the worst 5 days since December of last year. And this has to do with the fact that their growth, it really is not there, and it hasn't been there for several quarters on the sales upside. Some investors, the fact that they're suggesting that they don't think that it's going to be coming back anytime soon, maybe not even for that all-important December quarter. This is the Apple chart that we were showing for a couple of weeks, suggesting that this convergence tells you that the buyers are growing tired. Well, this suggests that you are going to see probably at some point Apple consolidate down to that 200-day moving average closer to 160. It may not be exactly there. And you can also see how quickly this stock went from overbought to oversold. So investors really caught off sides by this, which is interesting because that negative growth has been sitting there in models for quite some time. As for what this could mean for the markets more broadly, Guy, well, of course, Apple is the biggest weighting to the S&P 500, the second biggest weighting, ironically, to the NASDAQ 100. So on the year, here's the S&P 500 up about 20%, maybe a little bit less at this point. The NASDAQ 100 up about 40%. Apple had been up about 51%, but now Apple is underperforming the NASDAQ 100. The question is, if this Apple selling continues, the sentiment, the momentum of it, is it going to drag on the broader markets, Guy?
It's interesting listening to Mike Wilson talking about maybe the S&P touching its 200-day moving average. Abigail, thank you. Abigail doing a little more tampering in the markets and on the charts. Let's turn our attention back to commodities. And Rebecca Patterson was talking about what's happening with gasoline prices a little bit earlier on. I want to come at this through the kind of lens of what's happening in Ukraine, because I think it's really relevant. This weekend, Ukrainian drones, crippling a Russian naval vessel and an oil tanker. The attacks put Russia's commodity exports at risk. I just want to talk about the scale and what impact this could have. Mark Champion, Bloomberg's senior reporter for international repairs, joining us on the phone to talk about this one. Mark, can you talk about how exposed Russian commodity exports could be if we see a continuation of the kind of scenes we see on the screen in front of us?
Right. I mean, there are two things to think about here. So, first of all, is just the scope. This war has now moved into the Black Sea. It's affecting Russian assets as well as Ukrainian assets, which it has for some time. And the Black Sea is incredibly important. These are the two largest grain exporters in the world, Russia being the largest. Its exports haven't really been affected yet. But, if they are, virtually all of its grain exports go out via the Black Sea. The second is that you've got 15 or 20% of Russian oil that also exits through the Black Sea. There's somewhere in the region of 2.5 million barrels a day that are going out from Novorossiysk and just the Kerch Strait right next to it. So, the scope is big. The question then is, can the Ukrainians carry through on their threat to put this stuff at risk? And clearly they made a showing over the weekend where they used these naval drones to put holes in two ships, a naval vessel and an oil tanker. Whether they can do that and whether they will do that over the, at a larger scale over a longer period, that is the question, and we don't really know the answer.
Well, Mark, to that point, there was some talk about this being retaliation for Russia not renewing the grain corridor. So if that's the case, if there's the tit for tat here, sort of where does this conflict in relation to commodities then move next between Russia and Ukraine?
Well, that's exactly it. The Defense Ministry, they literally said on their PR accounts, they literally said, two can play at this game. So this is exactly what the message they're trying to send is that, if the Russians continue with this, if they don't come back in the grain deal, if they don't, then, they can do the same to the Russians that the Russians are doing to the Ukrainians. And as I say, militarily, the Ukrainians couldn't have done this, some 6 or 8 months ago. These naval drones are new, for example, and now they can, but we don't know the exact scope of, their capability to keep it up.
All right, Mark, thanks a lot. We really appreciate you jumping on for us. Bloomberg's Mark Champion joining us there. So let's get more on the commodity fallout here. We're joined by Nadia Martin-Wiggin, partner and commodities analyst at Perto Securities. Nadia, why aren't commodities reacting to this? Like, where is the risk? Why is the risk not being priced?
Well, I think commodities have been strengthening over the last 2 months over the summer. So we've gone from a situation where the WTI market was net short, where we had a lot of bearishness in natural gas. A lot of that has moved out. Now we're in more of a balanced situation on oil and gas. We were trading at almost $87 a barrel Brent this morning after this happened. Now we've come down a bit, same with WTI, but we're still well above $80 a barrel. I think the risk is starting to play into people's heads, but I think one thing we have to remember is that the oil tanker that was hit was a small product tanker that was actually carrying oil to Russian military, right? So it is considered still a military target. So I think the market is still just getting its head around the fact that, okay, this could become larger scale. It hasn't yet. I think the other reason the market has been so short is because, first of all, there's been huge demand concerns, and second of all, we've been waiting for oil supply exports out of Russia to collapse basically since Q2 last year, and it keeps getting pushed ahead, right? And the IEA was saying it's going to be 1 million barrels per day, quarter-on-quarter change. Now they're finally bringing that down to 400,000 barrels per day, quarter-on-quarter. So it's been a bit of crying wolf, and now it's actually here, and the market's not reacting.
I'm assuming as well, Nadia, good morning, it's Guy, I'm assuming that we'd also find ourselves in a situation where Saudi Arabia would be able to compensate. Saudi Arabia seems to be dictating what is happening in this market at the moment, and were we to see any issues surrounding Russia, Saudi could easily compensate.
In the short term, absolutely. The question is, though, if it becomes a prolonged outage. And that's when we look at how inventories are looking for the second half of the year. They're going to drop hugely. We're going to be at an extremely low point in OECD inventories at the start of next year, where we were at the start of 2021. That's what builds the picture for $100 plus oil. So we need to look at the situation not only in 1 month, 3 months, but 6 months. And that's where I think Saudi Arabia would struggle to replace Russia in the longer term.
Yeah, it has to be consistent. So I'm just looking at a chart of gasoline prices, this national average gasoline prices here in the U.S. It's up 23% since the low that we hit in December, and it feels like there are just no levers to pull. How do you think this evolves? Because that's going to have a huge knock-on effect on inflation and sentiment, et cetera, here.
Absolutely. I mean, this is what the Biden administration is so focused on, right? It's about keeping energy prices low, gas prices in particular, and this is why they have been allowing Russia to export oil, why we've had the price cap, but of course the price cap on oil has been breached. We've had a drop-off in gasoline exports from Russia this last month, especially diesel, which is even a bigger part of the tightness globally, is actually the diesel market. One thing is gasoline, and that hits the general economies in Europe, the U.S., much more. We're, in as happy a place as we could be, given all of the geopolitics going on, and the American consumer just has to live with it.
How big a spanner in the works would a big Chinese stimulus plan be at this point?
It would absolutely drive up demand much higher. I mean, right now, the world keeps saying that, oh, China is underperforming. We've had record oil imports into China. We're up 1.2 million barrels per day, year on year. We have apparent demand, real demand even higher than those numbers. And this is when China's not really going for it yet. So I think that absolutely they could increase imports by 500,000 barrels per day very easily. They're preparing not only for a bigger growth in GDP, the reopening, because jet hasn't come back yet, but also a potential war. So they need to build up their strategic petroleum reserve that the U.S. has been pulling down. So I think that demand is absolutely sticking and going to grow.
So, Guy, if I was still in Oklahoma, and if I asked this question to some oil CEOs, they might say that all the administration has to do is call them up and work with them, and they'll wind up pumping more, and they get sustainably over and add $1 million barrels of oil a day onto the market. Maybe that might be the conversation.
It's interesting. So here in the UK, that's exactly what's happening. So the Sunak government has now decided that it's going to wring every last barrel of oil it can out of the North Sea. And it's decided the politics is pointing in that direction. And you kind of feel like we're edging in that direction in the United States. The Biden administration has clearly been quite hostile towards the oil and gas industry. Is that now changing? And 2024 could change it dramatically, Washington's relationship with the oil industry. It'll be fascinating to see where we are this time next year.
Yeah, I mean, Nadia, to that point, why won't the U.S. just ride to the rescue? We're talking about China demand, you're talking about big deficit drop, we're talking about Saudis rescuing and jumping in. Why isn't just the U.S.?
Well, the model has changed, right? It's about shareholder returns. We see the rig count continuing to drop. It dropped again this week in the U.S., even though oil prices are so high. So that relationship is absolutely not there between the government and the producers themselves. We've had to bring down our supply growth in the U.S. multiple times this year. We're down to 600,000 barrels per day year on year. I think it's at risk of 400,000 barrels per day year on year. We might have zero growth next year because the environment has been so negative towards these producers, but at the same time, costs are going up.
Yeah.
From the peak, the costs of rigs and operations, they're down maybe 10%, not 30 or 40%. So it's much harder to produce oil at the prices that the Biden administration wants, which seems to be in the 60s, because that's when they're willing to refill the SPR, right? $67 to $72 at best. And that's not the price at which oil producers in the U.S. are happy to drill, baby, drill.
It's interesting, isn't it? politics is going to be dominating. So the political narrative around this could shift so quickly. Nadia, thank you very much indeed. Nadia Martin-Wigan, partner and commodities analyst at Parento Securities, joining us from Oslo. Coming up, we're going to talk about what's happening on Wall Street, a big leadership change at UBS. We'll figure out what is happening here. The reshuffle clearly following its emergency acquisition of rival Credit Suisse. We're going to bring you our exclusive take on this story. Wall Street Beat is next. Charlie Basak is next. This is Bloomberg.
Bloomberg Television is sponsored by Merrill, a Bank of America company. What would you like the power to do?
Today's the day you graduate from Southern New Hampshire University.
I've been waiting for this day my whole life. The fact that I get to walk across the stage and get my degree is honestly unreal. Don't ever stop. Keep on believing in yourself. It is never too late.
If you're out there and wondering if you could be an SNHU graduate, today is the day to find out.
Visit snhu.edu.
Private market alternatives help you outperform the traditional portfolio by up to 40%. Meet Yield Street, the leading private market investment platform with 10 highly vetted asset classes. Diversify with alternatives. Open an account at yieldstreet.com.
There's an easier way. With Thumbtack. Download the app today and care for your home from top to bottom.
It's not just designed to look good. It's built to command attention. It's not just a comfortable interior. It's a quiet refuge. They're not just headlights. They light the way forward. The new fully electric Audi Q8 e-tron models.
76% of 23andMe Health customers surveyed reported taking healthier actions because they know health isn't just a future state. Health happens now. Start your DNA-powered health journey today with personalized insights from 23andMe.
Hey, corporate types, will you stop calling each other rock stars?
You're a rock star. You are a rock star.
Rock stars, please.
You know what it takes to be a rock star?
I've trashed hotel rooms 43 times.
I was on the road since I was 16.
I've done my share of bad things. Also, your share of bad things. We know that using Workday for finance and HR makes you great for your job. That don't make you a rock star. Teddy, finance, you're a rock star.
Hey, Liz in HR, can you do this?
Unless you work with an actual rock star.
You are a rock star.
Thank you.
Hi, how are you? Hello, Oslo. Give it up for Pam. Pam, you are a rock star. Wasn't gonna say it.
This is Bloomberg Markets. You are looking at live pictures of the principal room. Coming up, Kathy Wood, ARK Invest CEO, joins Bloomberg Television at 1 p.m. New York time. You never want to miss what Kathy has to say. This is Bloomberg. All right, time now for Wall Street Beat. We take a look at what's buzzing on Wall Street and the world of banking and finance. And today, we're looking at many things. But we're going to start with the reshuffle of the investment banking division over at UBS. Bloomberg Charlie Basak got that scoop for Bloomberg. Charlie, what are the highlights here?
Miriam and I had reported here that this is a long time in the making and a very big announcement. We are talking about almost 40 leadership positions announced over at UBS in the investment bank, where we know they're making pivotal changes. Fascinating restructuring, because we know that they brought over talent from Barclays and other areas of the industry to beef up this investment bank before they are cutting hundreds of jobs. When you look through the entire UBS Credit Suisse workforce, who's in, who's out? At UBS, you have Mike Santini, who is one of the executive chairmen at the investment bank, about to leave UBS. So you have three major UBS bankers leaving in this reorganization. You have Ross Stevenson, long-standing banker, one of the most senior females in investment banking, taking pretty much Mike Santini's role here as the chair of an investment bank. And you do have In that 40 leaders, you have about 6 of them being Credit Suisse employees. So you have some Credit Suisse floating into the leadership ranks over at UBS now, the new UBS Credit Suisse, as well as some Barclays talent. Really interesting mix of leaders here that you're seeing.
Great story, Shanali, great story. Let's talk about the deal drought and how it's digging up KKR. What's the takeaway there?
There are a few things to look at here. One is, yes, you do have definitely profitability slipping only because of that deal drought that we saw everywhere else. But you do have revenue here coming in above expectations. You also have earnings coming in above expectations, even as assets are coming in below expectations. So what is happening here? You have KKR really showing here that they are just kind of like Apollo and really pivoting here in terms of what they look like. And you have that insurance business that they oversee accounting for a very significant amount of their capital. About $200 billion worth of their capital is perpetual capital now, which reduces their reliance here on fundraising. And what you have is also a big pool of dry powder, about $100 billion here for KKR left to deploy. And of course, very active private equity firm, very active deal maker. You also see their returns in these businesses also starting to improve. So you do see this stock up on the day, on the heels of earnings that did beat expectations, but some areas falling a little light as well.
Yeah, but the profit, but then, take a look at his peers, and it seems better than some. Okay, let's just round it out with Jeff Curry, talking about leaving Goldman Sachs. Jeff, you gotta text me. What happened here?
Exactly, you probably know Jeff more than most people on Wall Street do, given his long-standing tenure on Wall Street, kind of more recently a bullish face of commodities. Why is everyone talking about this? One, Jeff Curry himself is a big name in commodities. Goldman Sachs' commodities franchise is among the most heavily watched on Wall Street, but, we were talking about this a little earlier also. It's kind of the Goldman model here, especially when you come to the research division. After a period of time, the most iconic names start to float out, and the question then becomes, what is the next generation that comes up? Do they have the same kind of star power? Because as we know, that these folks are the most front-facing of the big investment banks, their sales, research, and trading division. And, another part of what will lead to the second Goldman Sachs Part 2, Part 3, in terms of what their talent story looks like. Where's he going?
Absolutely.
I think biggest question.
Yeah, that we're all waiting to see what's going to... Where's he going to land? I think is the key question. Will it be in Europe rather than in the United States? He said he spends a lot of time over here. Shanali Basak with the Curry takeaway. Thank you very much indeed. Coming up, Siemens Energy facing headwinds. Its wind power business staring at a potential $5 billion loss. One of the company's latest crisis. That's next. This is Bloomberg.
The Principal Room, brought to you by Principal Asset Management. Specialized expertise, unique perspectives, optimized results. Principal Asset Management, actively invested. Learn more at principalam.com.
I love my parents. So as they've gotten older, we've had to have some not-so-fun conversations about their wishes if something were to happen to them.
As an estate planning attorney, most people that would come to my office were looking to create a will for their family, but many couldn't afford the fees.
That's why we started Trust and Will, a modern and affordable approach to estate planning.
Attorney-designed documents, customized by you, all through an easy-to-use website.
The way a will should be. Find the plan that's right for you at trustandwill.com.
My hair was thinning. I automatically knew it was stress. I like Nutrafol because it's drug. I just recommend a hair growth supplement. Now you can see my hairline, and it's giving me my confidence back.
Get started at Nutrafol.com/man.
How do you commit the perfect murder?
Do you think we'll be able to find the cause of death?
We've got this all wrong.
The data is telling me the truth.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
thing is clear. It delays our path to profitability in the wind business, which we have stated before. However, obviously, there's more than just fixing the quality problem. We will look on the overall package and say this is how we're going to do it, and this will be in November.
Siemens Energy CEO speaking to Bloomberg a little earlier on today. This after the company released its latest rather disappointing results. The company reporting problems with its wind business. To fix these problems could lead to an annual loss of around $5 billion. Bloomberg's Rachel Morrison leads the team that covers this whole area. Rachel, how much of this is Siemens specific? How much of this is industry specific? And how much of what we heard there can I extrapolate into Vestas later on this week?
Some of the specific problems with the onshore wind turbines that Siemens is making are specific to them. So these are problems when parts of the turbines have been manufactured and they've been keeping quite quiet on the extent and the cost. So today this is showing just how big that loss is going to be as they try to sort of fix this problem. Some of the other issues that are leading to that loss are in the offshore wind industry. In their business there, if some customers that they've sold turbines to take up parts of the contract, they will make a loss. So that really does spill over into the rest of the industry because that comes from higher supply chain costs. It's costing these manufacturers more to make wind turbines than it used to, and they're locked into contracts at certain prices, and that's a problem. So as you mentioned, we have Vestas later this week. Previously, they reported some surprisingly good numbers, so it'll be quite crucial to see whether those are good or back to sort of being disappointing again.
Rachel, I also wonder how much of this is we haven't lived through a full cycle of wind turbine development, deployment, equipment fixing, and replacing yet. Like, if we haven't done that yet, this is all still in some ways very new territory.
Yeah, I think that's right. And also the push from policymakers to go faster and faster on the renewable rollout, sort of saying we need to get more of this capacity built, leads to companies just pushing out turbines, particularly in this case that they said they hadn't really tested as widely and, you know, as in depth as they should have before putting them out to customers. So that does kind of show the tension there between really wanting to speed up the transition and making sure that the equipment is up to scratch. And Siemens has had lots of problems in this area. So I think you're right. It does show that they need to put something in place. I'm not sure it's quite clear from what's been announced today that we know exactly how they're going to do that, but it's clear they cannot keep going on with these kinds of issues.
The video there's incredible. Guy fixing the end of the wind turbine blades as it moves around. That like amazing imagery just kind of shows you the scale and the complexity of what we're really dealing with here. Rachel, fantastic as ever. Thank you very much indeed. Bloomberg's Rachel Morrison. We'll look forward to Vestas numbers and the coverage a little later on this week. Let's talk a little bit about what is happening in the markets. Day one of the week last week, incredibly turbulent. I think maybe the fireworks this week could come at the back end of the week as we have the US CPI print, but nevertheless, a lot of Fed speak and still a lot of earnings to work our way through as well. Siemens Energy, we've just been talking about it. That stock down by 5.72%. At a single stock level, we are still seeing quite a lot of volatility, and that's where the volatility is showing up. At an index level, this still feels like a macro market, but at a single stock level, it's by definition much more bottom up. A little bit of turbulence in the 2-year a little earlier on today over in Germany to do with the Bundesbank and the way it is treating government deposits. That market, there's been a little bit of a sort of isolated case. Elsewhere, we've seen yields continuing to shift higher. Stock 600 today, big calmed, I would argue, 459. Nothing really happening at an index level. As I say, I think we're going to see the fireworks a little bit later on this week. That is where we could continue to see maybe turbulence, particularly around the bond market, bleeding back into what we're seeing with equities. But we've still got a whole bunch of numbers still to come. The earnings season is sort of fading, but not done. You've only got to look at some of the AI stories that are coming out a little bit later. Palantir is going to be out as well. We'll look forward to those earnings a little bit later. Coming up, we're going to continue our conversation. Europe versus the United States. Ruqaiya Ibrahim, Daily Insight Strategist of BCA, joining us next. We'll carry on the conversation there. This is Bloomberg.
To Avalara, we can calculate sales tax automatically. Avalara.
What if tax rates change? Filing sales tax returns, business license guidance, cross-border sales, item classification. Does it connect?
These bills are crazy.
She has no idea she's sitting on a gold mine. She doesn't know that if she owns a life insurance policy of $100,000 or more, she can sell all or part of it to Coventry for cash, even a term policy.
Even a term policy?
Even a term!
Find out if you're sitting on a gold mine. Call Coventry Direct today at 800-383-9200 or visit Coventry.
I have active psoriatic arthritis, but with Skyrizi to treat my skin and joints, I'm feeling smooth. Along with clearer skin, Skyrizi helps me move with less joint pain, stiffness, swelling, and fatigue. And it's just 4 doses a year after 2 starter doses.
Serious allergic reactions and an increased risk of infections or a lower ability to fight them may. Tell your doctor if you have an infection or symptoms, had a vaccine, or plan to.
There's nothing like clearer skin and better movement, and that means everything. Ask your doctor about Skyrizi today. Learn how Advil can help you save.
Customers love their secure internet. Jean says, I feel secure using Optimum. Get internet with plans starting at $60 a month with a mobile discount. Switch now and get up to $200 back. Call or go to Optimum.com/visit.
Moving? Get our best deals and save more. Stay connected in your new home with fast fiber internet and 99.9% reliability. Plus Optimum Mobile with unlimited talk and text and coverage on a nationwide network. Move with Optimum and our best offers today. Call 877-848-6329. Go to Optimum.com/moving or visit a store today. Get closer, go farther with Optimum.
The professionals at Robin Hood Solar Group help homeowners save money by producing their own electricity with solar. Let us show you how you can take advantage of federal and state incentives. $0 up front for installation. Fixed monthly payment that will never go up. Call today for a free price quote.
SmartAsset.com.
For the ones ensuring the job always gets done, and the ones wearing many hats, Grainger offers professional-grade industrial supplies and real-time product availability. Call clickgrainger.com or just stop by. Grainger, for the ones who get it done.
It's an amazing thing when you've showed generosity of spirit to someone and you want people to be saved and to have a better life, then you don't stop.
We have been able to reach over 100 million people impacted and affected and at risk of HIV.
The Rocket Fund takes all of the work that we're doing all over the world and looks at the most effective ways to get resources to them, to get services to them. The idea that we have saved 5 million people's lives, it's overwhelming. It's everything.
Monday the 7th of August, to be honest, nothing to see here. European equities reasonably becalmed. The fireworks, as I say, probably later on in the week. We've still got a few earnings to get through. At a single stock level, there's action. At an index level, there is none. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So, equity markets thus far this year, definitely macro-driven. That has been the narrative from the get-go. The earnings season provides a brief interlude when we can actually look at companies and figure out what is happening and maybe make a picture on what is happening out of that to the earnings narrative and where we're going from here. But then we snap back and we talk about macro. Today, I think we're waiting for some macro news. The earnings news isn't sufficient to move these markets at an index level, so we're waiting. We're waiting for more of a macro catalyst. It probably comes at the back end of the week. Siemens is a perfect example. Look at this. Bottom up, single stock, 5.82% to the downside. This company clearly has problems, both in terms of its manufacturing and its contract writing. We'll see what Vestas does later on this week. The UBS story is interesting as well. What is happening within the business. Shanali's great exclusive in terms of the management shift. That stock up by 0.4%. Still feels like a macro story. And where does that leave Europe, I think, remains a big key question, Alex.
All right, in the U.S., Guy, you got the S&P up by 0.5%, which is quite surprising considering the fact that there's not really big news. Volume isn't terrible either. I found that to be a bit interesting. Now, you're talking macro. I'm going to talk the micro a bit because you got Tyson and Apple. So let's talk about Apple, down by over 2%. You're now looking at the longest losing streak for Apple since December after earnings disappointed last week. So how much until Apple starts to drag down the Nasdaq 100? Now, Tyson had a really interesting read-through here. That stock getting hit pretty hard. A couple things. They missed on earnings, missed on sales, and they lowered their margin outlook for the pork division. So there's a lot of stuff happening with Tyson. They're also shuttering their chicken production factories. We're going to get to that in a second, but talk about that sort of bottoms up. That does not look very good for Tyson. Now, ending on the macro, looking at the 10-year yield, up by 5 basis points. We came in, it was up by 8 or 9, continuing that trend from last week, except for Friday, and now we're just up by 5. But nonetheless, higher, stickier rates. Michelle Bowman talking about that earlier as well, Guy.
And where does that leave, therefore, this story about where you park your money, particularly when it comes to equities? Are we back to talking about Tina? There is no alternative to equities, given the turbulence we're seeing in bonds. Do you want to be owning bonds at this point? Certainly the last 10 days have been very difficult. So if you're back to equities, where do you then put your money? Well, one of the clear trends of late has been to focus on the United States, and to a certain extent that trend accelerated this year. But are we starting to see some signs of stabilization within that? So this chart goes back to 2013, and you can see the gap widening, the discount that Europe trades at versus the United States. It accelerated in the middle. We're now starting to see, Alex, maybe a little bit of stabilization within that discount. But does it continue? Europe is more cyclical. If we get a soft landing, what happens in that scenario to that cyclicality? If we have an absence of growth, do you actually want to own the growth stocks that do exist and can produce growth? That's US tech. There's all kinds of questions which make life very difficult for Europe. But one thing is certainly enduring. Europe is cheap, but do the earnings justify that cheapness, or do they tell us a different story going forward from here? Up until the back end of last week, the European earnings season, Q2, was horrible. We saw maybe that being rescued last week a little bit, but does it change the overall narrative? Is US exceptionalism still a factor?
Yeah, but at the same time, you have to wonder too, if everything is kind of, you don't know where it's going to go, why not buy something that's cheap, like the UK, for example? So let's get into it. Do earnings prove U.S. exceptionalism? Focusing on the second quarter. Joining us now for his take is Bloomberg's Michael Miska. Michael, what do you think? Do the earnings prove it?
Well, it's a good question. So, like I was saying before, the earnings season was pretty bad in Europe. It got much better. If you look at, basically, the reason why this earnings season is so bad in Europe is because of material and energy. And this was always expected. You had commodities prices coming down versus last year, the comparable to the second quarter, and those earnings would come down dramatically. Now, given the weight of this sector is quite high compared to the US in Europe, you have an impact. If you strip those sectors out of the earnings growth, you have positive earnings growth in Europe. Also, the breadth of beat, same as in the US, less than in the US, but still, we're running close to 60%, I think, beat, so not too bad, I'd say.
Okay, let me take this from another angle. Why do I care about all of that? This is a macro-driven market. The US is heading for a soft landing. I don't hear any soft landing conversations happening in Europe right now. If I'm sitting in the United States, why, despite even what you just told me, would I move money out of the US and into Europe? It's okay. It's the numbers you're telling me are not that bad, but are they good enough to justify taking money out of what could still be an overheating US market into a relatively cheap European market?
Yes, exactly, Guy. I mean, if you consider that the US market is overheating and that there's a slight bubble building up in the tech sector, which still accounts for 25% of the S&P 500, then what do? You kind of want to diversify. If you think that the landing is going to be soft, or even if you think that the recession is not going to be that bad, yeah, exactly, then you might want to own some cyclicality. You might want to own something that's trading, like you showed just earlier, at a very significant record discounts, actually, to the US market.
But there's a correlation between equity market performance and the underlying economy at some point, isn't there?
Yes, there is. But it works with a lag, as always. I mean, if you look at the European stock market, it's been dislocated from the survey data that we've been reading, like the PMIs, for example. But what people expect is those PMI to come back up. Market kind of thinks ahead. They want to go. They want to look forward to those moments, and at the moment, without information that the economy is going to drop drastically, people are not ready to sell hard.
Yeah. Well, then let me ask you it a different way. Do we need to see 2024 GDP growth estimates pick up for U.S. equities to make sense?
Not necessarily, because the market in the U.S. especially has been driven by the tech sector. And I'd say at that point, that sector doesn't really care about GDP forecasts. I mean, that's what's been happening all over this year. Whereas the consumer sector, which has been doing quite well in the US as well, that's been driven by the soft landing narrative, I would say.
Alex, the other thing that I don't think we talk about enough is what is happening in China. Europe is heavily exposed to China. We think about what's happening with the soft landing in the States, soft landing or not in Europe. But China could hold the keys to what happens around the investment case in Europe. If we don't see big investment, if we don't see big stimulus, if we don't see an economic recovery, you've got to wonder where the catalyst comes to generate any kind of outperformance for Europe. It does seem as if Europe's fate from an equity point of view may not lie in the United States, but actually may lie in China.
Right, and Michael, you can make the argument that the reason why there was some kind of valuation gap that closed a bit earlier this year was because of China, and that without it, it's going to be hard for Europe to do any kind of valuation rethink.
Yes, that's true. I mean, that chart that you've been showing is telling the whole longer-term story. It's a discount that's been growing and growing, because every time there's a worry, a macroeconomic worries, people stick to defensive allocation, and defensive allocation is U.S. assets. So dollar, U.S. equities, tech, and defensive sectors as well. So yes, it's true, without potential recovery in China, or at least hope that there will be recovery in China, or a real recovery in Europe as well, which is where the economy is doing much less good than in the US, then yeah, Europe might struggle.
So the macro market, it's interesting to see the dollar actually strengthening, and maybe that's also a tell on what is happening here. Michael, always fantastic to see you. Thanks for stopping by. Michael Masika, Bloomberg's Michael Masika, on what is happening with that spread. Okay, coming up, more on our question of the day. Does the earnings season basically prove the reason for US exceptionalism? Ruqayyah Ibrahim, Daily Insight strategist at BCA Research, joining us next to discuss. This is Bloomberg.
For the third consecutive year, the number of hedge funds on Interactive Brokers' platform increased at a higher rate than any other leading bank or broker. Interactive Brokers serves both organizations and individual investors. To get better results, switch to a better platform. The best informed investors choose Interactive Brokers.
Too many companies are taking shortcuts and relying on estimates in ESG reporting, and CFOs need to get ahead of that. ESG reporting has become as important as financial reporting. CFOs have a critical role in becoming the storytellers for the ESG reporting. CFOs are uniquely positioned to work across different functions to extract the relevant data to meet the disclosures requirement as mandated by the government or the regulators.
You can't buy great conversations or moments that matter, but you can invest in them. At T. Rowe Price, our strategic investing approach can help you build the future you imagine. T. Rowe Price, invest with confidence.
If you have employees, you need to check out the ERC program, Chef Wonderful. Why, Mr. Wonderful? Because it's cash flow that you don't have to pay back. Good to know. This guy's so smart and so handsome. Go to wondertrust.com to see if you're eligible.
Fabulous surroundings, but everyone's looking at their phones for financial insights from Merrill. Is he hailing a ride to the concert hall? No. He's making sure his portfolio and retirement plans work in harmony. They want to adopt a child and build a new home, so they're talking numbers with their Merrill advisor. She's not researching her next role. She's learning how to handle market ups and downs without the drama.
Personalized advice so impressive, your money never stops working for you. With Merrill, a Bank of America company. What would you like the power to do?
Why do the biggest names in business choose Bloomberg? Great question.
Great question. Great question. Great question. That's a question I get all night.
Bloomberg, top experts, great questions.
This
this is the great conundrum right now because the consumer we know is strong, tight labor markets, incomes are growing faster than inflation now, and so that's supporting earnings and dominating, even though the Fed is continuing to remove liquidity. And as Michelle Bowman just said in that clip, they're not done yet. So for now, I think that the consumer is creating that U.S. exceptionalism, and that's dominating the Fed.
An exceptional U.S. consumer. I think we know one or two of those. That was, of course, Rebecca Patterson, former chief investment strategist at Bridgewater, calling out Alex. No, sorry. Speaking in the last hour. Let's go back to our question of the day. Does the earnings season prove U.S. exceptionalism? Let's carry on the conversation. Ruqaiya Ibrahim, Daily Insight strategist at BCA, joining us now. Ruqaiya, when we look at the earnings season that's been delivered thus far, do European earnings justify putting money to work in the United States? Is the European earnings season in any way good enough to justify putting money to work in Europe rather than the U.S.? What do you think?
Well, I think what matters probably more than what the earnings season that we saw in Q2 is telling us is what we're probably going to see in Q3 and Q4. And in that sense, I think that there's a possibility that we're going to see some of the positive things that happened in the U.S. in the first half of the year occur in the Eurozone. So what do I mean by that? What I mean is that, as your previous guest said, there's in the U.S., the consumer is strong, and that reflects falling inflation and the positive effect on real wage growth. The inflation story is a little bit lagged. And so what we could see in the second half of the year is that falling inflation there supports real income in the Eurozone, and that could boost the consumers there. So, in that sense, I think an interesting way to sort of play out in the markets is that you could favor the small cap Eurozones versus the U.S. small caps. And that could, be a way to play out an improvement in the situation among Eurozone consumers. The other thing is that the global manufacturing sector, that could also improve, and we can go into detail on that. And that would also support the Eurozone temporarily. But ultimately, there's a cap on how much the Eurozone it will improve, and that's because China's not stimulating aggressively, and that's because the ECB has hiked aggressively. And so there's really a limit to how much this will play out.
It just seems to me that the impulse for consumers to spend in the U.S. versus Europe is different based on COVID, right? Here we cut checks to people, there people stayed employed, and that led to a tighter labor market here that led to more competition, higher wages, relatively, I guess I should say, than Europe. Why are you so convinced that there are more Alexes out there in Europe who'll spend more money in shopping?
That's a great question. So as I said, a big part of it is just the fact that inflation is coming down. That's going to boost the real wages. And the other thing is, one of the factors that contributed to strong U.S. growth, U.S. consumption, is the excess savings that were accumulated during the pandemic. Now, in the Eurozone, there's also excess savings that are waiting to be spent. And if you take a look at what's happened with consumer sentiment surveys, they've actually been improving over the past little while. And so as consumer morale improves, that's going to improve their willingness to spend. And as real wage growth improves, that's going to improve their purchasing power, their ability to purchase, and that could contribute to a temporary improvement in consumption there.
Ruqaiya, do you think we have hit the low point in this cycle in terms of the discount that Europe trades to the United States? Does it get worse from here? Does it get better from here?
Well, at the end of the day, the Eurozone is much more exposed to global growth. And although I do think that there's a possibility that the Eurozone growth could improve over the remainder of the year, I think that improvement is going to be rather modest. And over a 12-month or 18-month horizon, the U.S. picture is going to deteriorate. I think that the impact of the Fed tightening is going to start playing a greater role. And the Eurozone is exposed to that. So I think that there is scope for the Eurozone to improve temporarily over the coming months, but ultimately over a cyclical horizon, that there's a limit to that, as I said, also because of the ECB and because of what's happening in China.
Well, also we're seeing U.S. really drag up European yields also. Like there definitely are alternatives to equities now. Why not just go buy the German 30-year at its highest level since January 2014 instead?
Well, we actually don't think that there's much room for Eurozone yields or for U.S. yields, for that matter, to rise much further from here. And the reason for that is that ultimately what, according to our framework, what drives yields is what happens to policy rates. And on this front, We believe that in the U.S. as well as in the Eurozone, both central banks have likely implemented their last rate hikes of the season, of the cycle. There's a possibility that, the Fed or the ECB could hike by one more time, but that's not our base case scenario. And so that's really going to limit how much upside there is for both German Bund yields as well as the U.S. Treasuries.
What about cuts? What do you think about those? When do you think those come?
Well, I don't think that either central bank is going to be very eager to cut prematurely. Now, I think that there's still going to be concern about the inflation outlook, especially if, as I expect that there's going to be a slight improvement in Eurozone growth in the second half of the year, and the U.S. Economy is still resilient. So I would not bet on imminent, like a very quick pivot to rate cuts from either the Fed or the ECB. But I do think that that's probably going to occur sometime in 2024, maybe the second half of 2024. But I don't think that they're going to be fast enough to save either economy from ultimately hitting a recession.
So here's my question, Guy. If that's our setup for the U.S. and Europe, where does that leave the U.K.? Because if you're talking cheap, you're talking underperformance, that zeroes into where you are.
Absolutely. The UK is very cheap. Does have exposure to commodities, so it'll be interesting to see what ultimately happens there. The UK savings rate is also relatively high. I know you like to cast a lot of shade on the UK.
I do. I totally do.
And it has been an ongoing theme. But the UK hasn't hit a recession. Germany has. The UK is basically just going sideways at a very, very low level. And it's interesting to see. So we're going into an election next year. The UK is in desperate need of a productivity improvement. If you look at any economy around the world and try and figure out how to improve productivity, the lowest hanging fruit, you could argue, is in the UK. And I've just been thinking about this over the weekend. I keep reading really negative articles about the UK. But if ever there was an economy that has the potential to improve even marginally its productivity and have quite a big impact, I think it could be the UK, which still, I have to say, has yet to hit a recession.
Rakaya, what do you think?
Well, I think the one factor, the biggest headwind in the case of the UK is the BOE. And what we saw from what they said last week is that, they're still concerned about inflation. And the reason for that is because of wage growth. And that's still rising. The labor market is tight. And ultimately, they need to make sure that that rolls over before they can really pivot to pausing and eventually cutting. Now, having said that, the UK economy is also struggling. If you take a look at what's happening with the housing market, for example, and so we are seeing the impact of the rate hikes, and it's just going to be a matter of time before that hits the UK economy. So I would expect that out of the US, the Eurozone, and the UK is going to be the first one that experiences recession.
We're just waiting for it. Pushed out, still waiting for it. All right, thanks, Guy. I really appreciate it. Rakaya Ibrahim, Daily Insight Strategist, BCA Research. Thank you very much. See, it's not just me that hates on the UK sometimes, guys. This is Bloomberg.
If you're thinking about earning your degree online, SNHU can help you get there.
I felt supported throughout the whole process, even from the first call. My advisors consistently reached out and guided me along the way.
It was like I was talking to a friend, like someone that I had known for years.
The instructor is very helpful with everything that I was going through. We'll be with you from day one, graduation, your degree. It all starts the moment you find your program.
Go to snhu.edu to get started.
76% of 23andMe Health customers surveyed reported taking healthier actions because they know health isn't just a future state. Health happens now. Start your DNA-powered health journey today with personalized insights from 23andMe.
We saw a huge push during the pandemic towards more in online spaces. I wonder what you think about artist royalties for AI art.
I think that AI can be used as a tool to augment human creativity and to extend the reach of what we can do. But human creators need to be compensated fairly for their work.
Hyundai Motor, connecting art and technology.
Sometimes you don't realize what's not covered by your dental insurance until you get the bill. That's why affordable dental insurance from Physicians Mutual Insurance Company is important. This isn't some discount plan. It helps cover things like cleanings, fillings, crowns, bridges, root canals,
any dentist you want, with no deductible and no annual maximum. For your free information kit with all the details, visit dentalnow.com.
Physicians Mutual, Physicians Mutual.
The first time you connected your GoDaddy website and your store was also the first time you realized.
Well, we can do anything. Cheesecake cookies? The cookie!
Manage all your sales from one place with a partner that always puts you first. Start today at GoDaddy.com.
Israeli Prime Minister Benjamin Netanyahu says that he is backing away from a planned overhaul of the judicial system and will instead focus on how judges are appointed. Now, the planned overhaul triggered protests all across the country. Markets agreed to those remarks with some skepticism. He spoke to Bloomberg earlier in an exclusive interview.
Well, I think that we've already done quite a bit. I've stopped the judicial legislation for 3 months, seeking consensus from the other side, unfortunately not getting it, then brought in a relatively minor part of the reform, and then said I'm still going to give it several months to try to get another consensus. What is it? It would probably be about the composition of the committee that elects judges.
With the selection of the judges?
Yes.
How they're selected?
Right. That's basically what's left. And because other things, I think, we should not legislate. I don't think we should move from one extreme when we have perhaps the most activist judicial court on the planet to getting to a point where the legislature, our Knesset, can just knock out any decision that the court makes. There has to be a balance. That's what we're trying to restore.
So Prime Minister, when you look at the change in selection for the judges, how quickly could that come?
Well, if we get a compromise, it could come immediately. If we can't get a buy-in from the opposition in the parliament, there's always a buy-in from the public. What is the thing that the public accepts? And I'm giving it my best shot. I'm spending, I would say, 24 hours a day on it. I'd say about 12 hours a day.
And if the public is not behind it, what do you do?
I think you should choose something. I think you should choose something that has broad acceptance.
Which looks like what?
Which looks like something that I'd like to negotiate, not even on Bloomberg.
The Israeli Prime Minister Benjamin Netanyahu speaking to Francine Lacroix over the weekend, addressing the key issue in his country right now, the judicial reform that we are dealing with and watching the reaction to. Alex, I think this is interesting, just an interesting moment maybe to factor in some of the political risk that for so long dominated these markets as we watch the Ukrainian invasion, as we watch some other events unfolding, clearly what happened around the pandemic. We're not really thinking about them at the moment in the way that we were. You do wonder how exposed market sentiment therefore is to a shock from that front.
Well, it also, if you had put on hedges to hedge any sort of big event, it just hasn't worked. And we talked earlier in the show about commodities in Ukraine and Russia. Everyone expected Russian output to fall really hard, really fast, and it still hasn't happened. Maybe we're seeing it now. So if you bet for that, you hedged for that, you lost money. Like it didn't play out. So unless hedges start playing out, why would you then use a hedge? However, then you are exposed.
Yeah, but next year has the potential, I think, to have much more political risk. At what point do we start thinking about 2024? It's interesting. The conversation's already beginning about when the Fed can cut rates. We were talking about this earlier on. Is the Fed going to find itself in a difficult position? Rebecca Patterson was talking about this. 2 cut rates in the back end of 2024 and risk being accused of juicing the US economy into that general election. I think that political risk narrative story is going to emerge much more strongly maybe over the next few months.
Yeah, Lori Calvasina of RBC has already been talking about this, that we need to start looking at 2024. This is how stocks perform in an election year, and these are some of the risks. And as Amy Wu, a Silverman, would tell you of RBC.
Yeah, it's interesting. Single stocks, you're getting volatility there, but headline level volatility, I don't think it's there. I want to show you some 52-week highs. A lot of defense stocks, speaking of this political risk, hitting 52-week highs today. Rolls-Royce, as of today, no longer has any sell ratings. That's an interesting position to finish with. This is Bloomberg.
When you automate sales tax with Avalara, you don't have to worry about things like changing tax rates or filing returns.
Avalara.
Some things are better left to a professional.
In hindsight, probably shouldn't have tried to remove my own appendix.
Like when it comes to finding financial advisors.
What was I thinking?
So leave it to Smart Asset to find them for you. Take the free quiz at smartasset.com. Then you'll be matched with up to 3 vetted fiduciary financial advisors. To get started, take the Advisor Match quiz now at smartasset.com.
The most award-winning musical of the season is Some Like It Hot. It's a supersized, all-out song and dance spectacular, and the winner of 3 Best Musical Awards. Some Like It Hot. For tickets, visit telecharge.com today. Every year, summer poses the same question. How do you make the most of every moment before it passes you by? The simple answer, don't wait. Get behind the wheel of BMW. You've always wanted. Tell summer, it's on. Don't miss out. The BMW Summer On Sales event is on now. Pre-in for credit of up to $2,000 in select models now through September 4th.
These are spectacular. I wonder who the artist is.
Glorious colors.
I can see myself in that backyard.
Cambridge pavers bring a backyard to life. Cambridge pavers will keep their rich colors and stay beautiful for years to come, thanks to unique Armortech process. Let Cambridge make a masterpiece of your home.
Dreams come true. The most award-winning musical of the season is Some Like It Hot. It's a supersized, all-out song and dance spectacular, and the winner of 3 Best Musical Awards. Some Like It Hot. For tickets, visit telecharge.com today.
There's something about having that piece of paper. Some people think that's worth more than my skills.
I've run this place for 20 years, but I still need to prove that I'm more than what you see on paper.
So good they can't ignore it. It's the way my mind works. I have a very mechanical brain. Analytics and empathy. That's how I'm getting clients. I am more. I'm more than what I am.
It's an amazing thing when you show generosity of spirit to someone and you want people to be saved and to have a better life, then you don't stop.
The idea that we have saved 5 million people's lives, it's overwhelming. It's everything.
So, it's hard to tell, to be honest, where they'd like to work today after the weekend. Maybe they're all just working from home. It is August. Actually, volumes haven't been that hit as a result of it being August, but nevertheless, today, at an index level, something of a non-event. I suspect that's going to change a little later on in the week as we see the macro story reasserting itself. But today, there are a few earnings that are worth talking about, but we're really waiting for the main event later on in the week with the US CPI data. So the DAX, nothing to see here. The CAC, nothing to see here. The SMI, nothing to see here. These markets are great. They are absolutely unchanged on the day. FTSE falls a tiny bit more, but we're down by 0.1%. So really, to be honest, Europe is in a holding pattern, waiting for the next catalyst. It did not come from earnings today. There you go, Stock 600, up less than 0.1%. We're trading just below 460. Choppy kind of, but within a very, very tight range if you extrapolate and widen the lens there a little bit. In terms of the single stocks, yes, there was some volatility here. Siemens certainly one of those stocks that we were watching out for. It's going to be interesting because it maybe sets the tone a little bit for investors later on this week. Some of the stories around Siemens Energy are related to its ability to manage supply chains, its ability to write contracts, but there is a bigger overall theme when it comes to wind turbines, so investors will be interesting on the back of that. UBS making some management changes, Sonali Basak breaking that story, and OHB, KKR is buying into its own private space. Basically, it's taking this space-related business, this satellite-related business out of Germany. Private, I think actually the bid was a little higher, I think it was around 44, but I probably need to check that. But a big bounce today, just proving that there is still a little bit of activity in the M&A space that can be done. And OHB certainly proving that. Final CPI numbers out of G. We've got Bayer. IHG is going to be interesting, the hotel group, in telling us what's happening with the consumer, that consumer spend story. Clearly this summer it's going to be hot in many ways. Aberdeen is out with numbers, so the earnings story is going to carry on. We've also And I think this is a really important point. We've got Glencore out. So we've already had a bunch of the mining numbers out already. There's a narrative to be deduced here on what's happening with China, what's happening with metals prices, what's happening with coal, what's happening with M&A. But it's interesting. This is a business, this is an industry that is something of a pivot point, Alex. So I think this is going to be an interesting set of numbers to dig into.
Yeah, especially when we take a look at, say, Glencore's bid for Teck. Teck Resources is a Canadian company. They wanted to buy the company, take its coal business, merge it with Glencore's, and then spin it off into its own company. That bid hasn't actually materialized yet. So knowing like how they're going to be looking at their coal business and then M&A, as you were mentioning, going forward. All right, so let's get more with Grant Spoor, mining and commodities analyst for Bloomberg Intelligence. Grant, good to see you. What are the tea leaves going to tell you tomorrow?
I think the key thing that we're going to look for tomorrow is how much cash Glencore returns to shareholders. Net debt should be very low, if in fact it's not down to zero, depending on working capital release. So by rights, they should be returning a lot of cash to shareholders. But we think they're probably going to keep their powder dry, particularly in anticipation. Well, they've done two transactions, smaller ones, Alunorte and the Mara transaction, and also potentially there's a cash outlay for Teck's coal business should they be successful in acquiring it. So I think they will probably keep their powder dry and may disappoint in terms of cash return.
How big a moment is this for mining? This is commodities more broadly have been focused on returning money to shareholders for a while now. It sounds like you're talking about something quite different. So how big a pivot point are we at?
Well, I think it's been creeping through, right? So we've seen the miners increase their capital spend, creeping up by $1 billion apiece over the last couple of years. We've also seen them engage in some smaller M&A transactions, nothing too big, but certainly bolt-ons. So I think this would be quite a big moment in terms of the mining industry saying to shareholders, we are now comfortable that we've earned the right to grow. And by the way, we can also grow on M&A. So I think it's quite a pivotal moment.
Grant, do you think that that's true? Like, have shareholders given them the right to grow yet?
I think we are in a market where perhaps an outsized return probably won't be rewarded as much as it was, let's say, a couple of years ago. So I do think there is an acceptance that the mining industry needs to grow. And I think particularly against the backdrop of decarbonisation and the whole transition metal story, where the demand numbers do look well, if you take them in isolation, stellar, but if you look at them in the broader context, pretty healthy.
To what extent are these mining companies still a play on China?
Still largely a play on China. So it has shifted. It's not all about China. There is an element of how much demand is going to come from the shift to EVs. Mm-hmm. But in fairness, a lot of that EV transition is happening in China. We're expecting it to come in places like the US and Europe, but for now it is still weighted in China. So yes, their fortunes are still closely tied with that of China.
Hey, Grant, this is a weird question, but I've been talking to a lot of oil CEOs that are talking a lot about lithium, and they're sort of looking through minerals and lithium through their water, and it just feels like they're trying to maximize the stuff that they have and get out as much as they can. What do the traditional miners like Glencore and traditional traders think of an oil company being like, yeah, lithium's cool?
Well, let me answer the question in a slightly different way. Do you think the mining companies have been a bit slow off the mark in terms of embracing lithium and some of the smaller transition metals that could potentially grow into much bigger markets? So I think, Glencore as a point, they've sort of entered into a pre-buy transaction. The Glencore of old would have taken an equity stake, perhaps done some financing or some debt to secure trading volumes. That's no longer the case. They've had to go and buy their way in. So it just shows you that the miners are probably behind the curve and scrambling a little bit to get into the lithium game, or the future-facing commodities, as they call it.
See what the numbers bring tomorrow morning. Thanks for setting us up. Perfect. Greatly appreciated. Grant Spoor, Bloomberg Intelligence, head of the Glencore numbers. First thing tomorrow morning, we'll, of course, break those down for you on European coverage. The European equity markets are now closed for the day. We're through the settlement, and to be honest, it was as boring as the rest of the session was. A tiny tick higher for the FTSE 100, which finished down by 0.1%. The Kekeron's finishes a tick higher, but not by much. Basically, we have had a holding pattern here. The earnings season has done nothing really to disturb, Alex, the bigger picture, which is basically, I think, waiting for the macro story to return.
Yep, or, September. All right, well, coming up, talking about sort of a big gap of nothing happening deals. They are down this year by about a third compared to last year. We've seen in all the private equity earnings that are coming out. We're going to look at the M&A market. Does it rebound? Or the bid-ask spread finally coming in? Mark Cooper, CEO of Solomon Partners, joins us next. This is Bloomberg.
If your roof is showing danger signs like streaks or raised shingles, it could be trouble. And a new roof could cost $10,000, $15,000, or $20,000. Introduce RoofMax, the first professional and affordable roofing treatment that is scientifically proven to strengthen and extend the life of your roof. With RoofMax, you'll have the protection of a brand new roof and save thousands. RoofMax's skilled technicians apply a safe, effective, and affordable natural treatment. And within hours, you have a roof that performs like a new roof. RoofMax's exclusive treatment resaturates old, dried shingles with a natural, bio-friendly formula that quickly restores flexibility and water-repelling protection guaranteed. Look, this is a 17-year-old asphalt shingle. It literally disintegrates. But here's an identical shingle that we treated with RoofMax's proven formula. It passed rigorous flexibility testing from The Ohio State University as a new shingle. So a RoofMax roof can also pass a home inspection if you're getting ready to sell or for insurance, saving you money. RoofMax has treated over 50 million square feet of roofs all across America. And just check out our website for the thousands of 5-star reviews.
I was skeptical at first with the existing condition of the roofs. We were having high winds and shingles were blowing off the roofs continually. But 5 years later, after the application, the roofs look great. And we have no issues with any shingles blowing off the roof.
Keep your family safe and happy with RoofMax. Call or go online now for a comprehensive leak threat analysis and roof maintenance tune-up. A $539 value free. RoofMax. More life, less money, guaranteed.
Call 1-800-519-9316. That's 1-800-519-9316. Or log on to roofmax.com. Call 1-800-519-9316 now.
Internet without trackers. Without malicious websites. Without malware-ridden files. Zen. Your data more secure. Your connection protected. Be more cyber zen. Get NordVPN. Enjoy cleaner, safer, and more private internet daily.
Private market alternatives help you outperform the traditional portfolio by up to 40%. Meet Yield Street, the leading private market investment platform with 10 highly vetted asset classes. Diversify with alternatives. Open an account at yieldstreet.com.
This is Bloomberg Markets. You're looking at pictures of the principal room, live pictures, should I note. Coming up, Kathy Wood, ARK Invest CEO, joining Bloomberg TV at 1 p.m. New York time. This is Bloomberg.
All right, one stock we're watching today is KKR. That stock up over 5%. So a couple things to look at here. Our earnings actually beat, but profit overall year-on-year did fall 23%. But compared to, say, Carlisle, that profit fell 46%. So not as bad. And some of the individual segments actually held up pretty well as well. You got leverage credit. Composite portfolio rose 3%. The traditional private equity portfolio was up about 5%. But. You had KKR definitely still echoing a lot of what other private equity firms have been talking about, is that it's really hard to find exit strategies. It's hard to offload some stuff in their portfolio, and it's still hard to find deals. There may be sort of a public to private thing happening, but it's still really, really tricky. And that seems to be the big question in the market come back. When will that big bid-ask spread on valuations finally come close enough that more M&A can really pick up?
We take a look at what happened this weekend and what we heard from Warren Buffett and Berkshire Hathaway. They're sitting on what is it, $147 billion in cash. Now, most of that's parked at the front end, gives them a lot of flexibility, gives them quite a decent amount of earnings as well. But what is interesting as well, Alex, is that they've been exiting businesses. And that tells you a lot about where the mindset is right now. It's a exit rather than acquire. And I think that is still speaking to the narrative you're kind of focusing on, which is this spread between the bid and the offer, and that still seems to be substantial. And there's still an awful lot of regulatory stuff as well that's making it more and more difficult to get deals done. So mid-market seems to be the area that everybody's focusing on. Is this the new normal, and how long does that last? Mark Cooper, CEO of Solomon Partners, joins us now. Solomon Partners specializes in M&A and restructuring. Mark, how would you describe the current environment right now? Has there been any big shift over the last few months that you can discern to end the stalemate that we seem to find ourselves in at the moment?
You know, there's certainly, and Alex said it perfectly, because, you know, both KKR wants to see exits, which they desperately need to show to their limiteds as they raise more capital, generate more acquisition opportunities if, in fact, their competitors are, in fact, doing the same. The answer is we're getting close. We're not there yet. And what do I mean by getting close? Well, it certainly seems, when you look at the numbers, that we've sort of bottomed out. So, you know, first half to first half seemed comparable. Certainly the trend over quarters, particularly the fourth quarter of last year, which was very bad, seems to be getting better. We also feel, or I feel, that the private equity community is leaning in and has great hope that they can realize on some of their exits that they desperately need. Mm-hmm. But to get there or not will be the question.
Yeah, Mark, what gets us there? Is it, I don't know, a better economy? Is it inflation falling? Is it the Fed saying something about cutting? Like, what gets us over the hump?
I think it's just stability in interest rates, and we're very close. So what we've been saying for the past year or half a year is that when the Fed finally caps out and we have a sense of what interest rates will look like over the long run, that's what will dictate value. Because on the one hand, the optimistic view is the Fed's going to cut, and so people don't want to sell or take lower prices because I think it's going to get better tomorrow. I don't believe that to be the case. And on the other hand, how do buyers price when they don't know what the financing cost is going to look like? Mm-hmm. And also, yes, the economic picture was a little bit murky, and that economic picture seems to be coming into more clear vision, and that will help.
Who's being more realistic right now, buyers or sellers?
I would say I'd say buyers are a bit more realistic at the moment.
So that's interesting. What does that then tell you about any distressed debt cycle? So we were talking to Henry McVeigh of KKR last week, and he was like, look, I don't think we're going to see a massive distressed debt cycle because inflation is going to still stay relatively high, but we will see a ton of restructurings. Is that playing out for you?
You're going to see more restructurings, but it's a tale of haves and have-nots. So if you're a marginal credit and you're looking for capital in the market, it's not there. And the only reason why you file bankruptcy is because of lack of liquidity, and we all know that. But for those who are actually doing well, there's capital. So it is a bit of a tale of two cities. I would put yellow, which everyone talks about, sort of a little bit to the side, because that was more structural, about operational issues. But when you talk about companies who back a year ago, 2 years ago, who are marginal operators, they would survive because they had access to capital. So yes, I think you're going to see a more active restructuring market, but I don't think it's going to be, back to the, the Great Recession type of restructuring market. I think it's just going to be a steady.
Mark, let me come back to the question I asked you just a moment ago. Buyers or sellers? Who has the most rational approach? Who has the most realistic approach? You said buyers, and clearly, I think that there's an element at the moment that sellers clearly believe that we are going to return potentially to a lower interest rate environment, which will have a knock-on effect in terms of valuations. Do you think that is true of distressed companies as well? They have managed to get themselves thus far, but is there a belief amongst those distressed businesses that we are going back to a more benign interest rate environment? Is there an acceptance among some that actually interest rates may stay elevated for a while?
Oh yeah, optimism prevails, and everyone believes that their baby is the best-looking one. And even if you're distressed, there's going to be a moment of epiphany, and the market's going to come back, and you're going to have capital, and everything's going to be fine. So when does distress become truly distressed? When you don't have a choice. And the same thing is true as we're seeing in the sell-side market with sellers saying they want to capitulate. It's because at the end of the day, they're saying, you know what, forget about 2021, even forget about 2022. Those days aren't coming back. This is good. It's still a great return for my investors, and I'm going to take that return and reinvest that capital in the marketplace. You're going to see more of that. That's the capitulation. It's not a serious capitulation. It's not, it's like going from a 3 times return to a 2.5 times return. But it's still that optimism that sits out there. Well, this market's going to come back, and interest rates will fall, and then therefore we'll see 2021 again. It's not going to happen.
So, Mark, if we readjust to rates, just to say 5.5%, just for sake of argument, for a while from the Fed, let's say for the next year, how does that, what's the biggest change in sentiment that we're going to see in your market?
So it'll be clear signal that there's no pot of gold at the end of the rainbow. You got to move now, and it's time to get back to business. We've operated in these interest rate environments for decades, right? 5% is not anything that we should be concerned about as a general interest rate environment, and it's certainly new business, buying and selling. And so now they recognize this is the new. They get beyond the historical high water marks, and they trade. We're seeing it in the amount of activity that's coming to the marketplace with the expectation that there'll be buyers. And I think people will transact, and I think this gap between buyer and seller will narrow very rapidly. And I would bet it narrows before year end.
Hey, Mark, really great. Love catching up with you. We'll catch up with you before year end to check in. Mark Cooper of Solomon Partners, thank you very much. This is Bloomberg.
Third kid? What if she likes playing golf? It's expensive. We're outlawing golf. Wait, can I still play?
Since we work with Empower, we don't have to worry about planning for a third kid. You can still play golf. Sometimes.
Take control of your financial future. To Empower. What's next?
There's an easier way. With SubTag. Download the app today and care for your home from top to bottom.
This is a keepsake frame. This is actually a photo from my wedding. I'm Adam Weiss, founder and CEO of Keepsake, the mobile app that makes it easy to have your photos printed, framed, and shipped to your doorstep. Just choose a photo that you love. You can preview it in over 100 frames, and in a couple of days, you're going to receive your photo in a beautiful handmade frame. So if you've got a special photo on your phone, install the free Keepsake app. We would love a chance to frame it for you.
The first time you made a sale online with GoDaddy was also the first time you heard of a town named Dinosaur, Colorado.
Just got an order from Dinosaur, Colorado.
Start an easy-to-build, powerful website for free with a partner that always puts you first. Start for free at GoDaddy.com.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Here's what I'm watching. You do not want to make this
He is there to kind of upside.
Change. It's the price of winning tomorrow. To adapt, you'll need trading technology that automates and scales. While our market-leading data reduces fragmentation between teams, we'll partner with you to define and deliver exactly what you need, helping you face change in ways no one else can. This is bigger thinking. This is Bloomberg for the sell side. Learn more at Bloomberg.com/sell-side.
Happy Monday in August, guys. That's what's happening right now in the markets. To that point, Abigail is tracking the moves. Abby?
Yeah, and this is maybe not the kind of move that you would expect in the summer, but in August, seasonally, we are starting to see some weakness. Over the last 5 days, we do have the NASDAQ 100 essentially down about 3%. But it's green. The reason it's green is I have it marked for a one-day change. So we had been up 0.7% for the NASDAQ, now up about 0.2%. A couple of minutes ago, basically flat. So investors still trying to make up their mind which way they want to go today after last week being the worst week since early March. As for the battle beneath the surface, if we take a look, we're going to see to the upside. Alphabet still folks buying that catch-up trade, gaining about 10% since it reported its better than expected quarter. Nvidia reports soon, up 0.7%. Will the AI boom show up there? Apple still under pressure for a lack of sales growth, and Tesla under pressure, perhaps as a longtime CFO is leaving by the end of the year. As for the S&P 500, these are also S&P 500 stocks. Take a look at this range that appears to be developing this year. It's a beautiful up range, but we happen to be at the top of it. It does look like we could drop down toward the bottom of it. That would be right around that 200-day moving average, or let's call it somewhere around 4,100, 4,200. If that happens, the question will be, will the bottom continue to hold? One pressure, one reason, Alex, to think that we could have stocks drop. Well, we do have the 10-year yield basically up and away since April. The question is, we do have some hawkish Fed talk, Fed speak today. Will we see yields go higher, specifically this 10-year yield take out its highs earlier this year, Alex?
Abigail, good stuff. Thank you very much. All right, let's stick with one stock in the market here. That's Tyson Foods. Shares are down by about 5 to 5.5%, but actually much better than they were before. They had weaker than expected earnings. They also announced they were closing down some of their chicken facilities. Joining us now with more is Bloomberg's Simone Foxman to dig into the numbers. They had already pre-announced, right? So or they already gave some warnings. Why was this so disappointing to the market?
I think there was some hope that the worst was over. We heard from Pilgrim's Pride, the second largest U.S. producer of chicken, just a couple weeks ago, and they really signaled kind of a bottom to that market. But the message from Tyson, just a bit more negative, really grappling still with some holdover in terms of dynamics from the extended post-pandemic. For example, with chicken, production shut down for the most part, then prices went up, and suddenly this production came back online, and then there was an oversupply of broilers, so the chicken products. That's sort of what we've seen happen as well in pork. Beef has some other concerns in terms of high input costs that are really dragging there, but overall, Tyson really underperforming analyst estimates on just about every metric.
So we're seeing chicken plants being shut down. This has been an ongoing theme, Simone. So is this just a continuation of current policy? What does this tell us about strategy?
Yeah, so these 4 new closures today, actually bringing the total to 6 for the fiscal year. This is all about a cost-cutting plan that we've seen from Tyson. It wants to invest in automation and digitalization, essentially to try and give it a better control of how much chicken is producing at any given time. We did hear from the executives saying this is not going to affect overall volumes. And analysts pretty positive on this. The problem, they say, is that this is not something we're going to see until well into next year, and that's why perhaps we're seeing the shares sink so dramatically today. There's a $300, $400 million charge associated with it as well.
Yeah, that doesn't feel good. But hey, it might be good when I'm going to buy some food. All right, Simone, thanks a lot. Bloomberg Simone Foxman joining us there. All right, so that kind of wraps up today, but there is still a lot to watch for the next few hours. You got earnings after the bell. Paramount, that is the parent company of CBS, MTV, and Nickelodeon. Another earnings layer, you also got Lucid, Palantir, Beyond Meat. I should really be interested in Palantir as well, Guy, and sort of what the long-term driver will be there. And Lucid as well, got dinged really hard. EV play, can they deliver, really?
How much AI is there going to be on that Palantir call? I suspect quite a lot.
Will it be enough? Just how many mentions?
Well, expectations. This is one of the AI stocks have been growing, certainly. So I think they have to live up to that expectation.
Yeah, and I should point out, again, we were talking about it earlier, that Morgan Stanley saying that we're near the top for the AI call. This is a really later cycle. It's already had the run, so will that feed into it as well? On a day where you're seeing the Dow up by 1% on what? I don't really know. It's a Friday. It's a Friday. I wish it was Friday. It was a Monday in August. S&P up by 0.6%. The NASDAQ 100 up by 0.3. That wraps it up for me and Guy. Coming up, you got the founder of VC firm Conviction will be joining Bloomberg Technology with Ed Ludlow coming up at the top of the hour. This is Bloomberg.
sales tax with Avalara, you don't have to worry about things like changing tax rates or filing returns.
Avalara.
It's not just designed to look good. It's built to command attention. It's not just a comfortable interior. It's a quiet refuge. They're not just headlights. They light the way forward. The new fully electric Audi Q8 e-tron models.
Optimum customers love their faster speeds. Upgrade to 1 gig fiber internet with greater whole home Wi-Fi coverage. Optimum customer Sylvia says it's really fast. Upgrade today and go faster. Now with speeds up to 8 gigs. And when you add Optimum Mobile, you can save up to $15 a month on internet. For your special offer, call 8885-OPTIMUM. Go to optimum.net/upgrades or visit a store today. Get closer, go farther with Optimum.
Danny loves Optimum Business's new fiber internet, now with speeds up to 8 gigs, saying extremely reliable. So we decided to review him back. Ordering ingredients with 99.9% reliability so they arrive 100% on time? Perfect score. Using Optimum Business Fiber with speeds faster than Verizon and Frontier to share your garlic knots. 10 out of 10. Join happy customers like Danny and get Optimum Business Fiber internet for as low as $65 a month.
This weekend?
You know, just robot stuff. A lot of chess. I was practicing for you. I know you're pretty good. Yeah, I don't like that. I will take this over here.
Not cool. Not cool. Alright. I will concede. I can see. Got me beat.
Very good game. Well played.
Thank you, sir.
Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Ed Ludlow in San Francisco. Caroline Hyde is off today. This is Bloomberg Technology. Coming up on the program, Tesla's shock change of CFO. Zach Kirkhorn has stepped down after 13 years at the EV maker. Meanwhile, Elon Musk's health is in focus as talk of a Zuckerberg cage fight heats up. And plugging a $48 billion black hole, artificial intelligence could fuel a rebound at SoftBank as the Japanese conglomerate's Vision Fund seeks to snap 5 quarters of losses. And we go live to Lisbon as a key leader responds to Portugal's probe into a European telecoms giant, Altice. First, let's get a quick check on the markets. Look at the index level, NASDAQ 100, very tech-heavy. We're basically flat, up 0.4%. Earnings is kind of a pull on that. The Tesla news sees Tesla's declines accelerating and dragging down. We'll get to that in just a minute. The yield on US 10-year Treasury is interesting. We are below 4.2%, but that has been the story. The sell-off in bonds, the push higher in yields, and its impact on the equity market. 2 single names that I'm flagging. Apple, down for a 5th consecutive day. That's the longest streak of declines going back to December. We had earnings last Thursday. Now we're worried about the smartphone market in the US. Later in the show, we're going to bring you details of the iPhone 15 with Mark Gurman. He wrote about that over the weekend. Palantir, down 5%, earnings after the bell. This is a stock that's gained more than 150 30% since its last earnings report. The Street expecting just 1 cent of earnings per share. We'll see if AI is boosting the bottom line. The name we are watching so closely, the surprise story this Monday that we all woke up to. Zach Kirkhorn stepped down August 4th as Tesla's CFO. You see the declines have accelerated, down 3% on Tesla. He's been at the company 13 years. He became CFO early 2019. He is a big factor behind the profit at Tesla, some of the key capital raises they have done. The chief accounting officer is going to transition into the CFO role. Kirkhorn's going to stay till the end of the year to oversee that transition. Pierre Ferragu of New Street Research currently has a buy rating on Tesla and joins us to discuss. Pierre, your reaction to Zach stepping down?
Well, very selfishly, and as an analyst covering Tesla, I'm very disappointed because Zach was like an exceptionally helpful CFO for analysts. Always very impressive in his ability to provide like a big picture and drill into very specific numbers he could give to give a good sense of what was happening. So the sense of control and understanding of how like the big Tesla machine works at Tesla was impressive, and I'm definitely going to miss it. It's also definitely a surprise. I was not expecting him to leave. He's very young. Now, as you say, 13 years as Tesla, 4 years as a CFO, still very young. A lot of things he can do with his life, and quite a good, amount of money in his on his bank account, because of course being the CFO of Tesla and going through such like an exceptionally strong stock performance means Zach already got paid very well for his time as Tesla. It reminds me, when Jerome left Tesla, it was the same thing. It's Tesla is a company that attracts talents the best in the world. Remember, they receive 3 million applications a year. It's also the company that has the most difficulties to retain them in the long run, because that's a company that is making talents very rich very rapidly at the same time. So yes, I think it's part of the model.
So Tesla's named Vaibhav Taneja as the next CFO. He's been the chief accounting officer. Do you know anything about him?
No, I don't have the chance to meet him personally. You know that Tesla is very protective with the time of their executives, so I had the opportunity to speak to Zach regularly, not so much to Vaibhav. He's basically coming from the ranks of Tesla. I'm very he will do a great job, and I hope I will forget very soon my regrets of seeing Zach leaving, and I'm sure Vaibhav will be very helpful with analysts as well.
Pierre, you and I on this program, Bloomberg Technology, have used and talked about the term key man risk. And the thing that we talk about in the context of Zach was that he was one of just a handful of stated executive officers, right? You have Drew Baglino leading the powertrain and battery business. Tom Zhu has now come in over from China. But does the key man risk conversation now get amplified because Zach, who's been such a stable force, is now gone?
It's a very good question. So key man risk, yes, you can't ignore that. A CFO leaves a company, the stock comes down, you can't that makes complete sense. There is like an optionality, a risk reflected in a move like that. You never know exactly what's behind it. And yes, a CFO, and especially a CFO with the talent of Zach is a key man in an organization like that. Now, if you take a step back and look at how Elon Musk likes to manage the multiple businesses he has, he likes to be directly speaking to very technical people, so people like Drew typically. Then he likes to have a type of either a CFO or a chief operating officer who is in charge of running the shop. And that's the model of SpaceX, that's the model more or less of Tesla, with like no real COO, but like a Zach and potentially Tom running the business from a financial and operational and commercial perspective. And so that model, once again, is extremely resilient as long as you have this capability of harnessing talents and bringing them up the pyramid. And look at someone like Tom, like the trajectory in China at Tesla. It's very similar to the trajectory of Zach in the finance department. Like, these people came in very highly selected by Tesla, and amongst all these very high quality talents Tesla has, Tesla is extremely good at promoting very, very fast, very young talents. So as long as that machine is there, as an analyst, looking at the stock, looking at the long term, even the medium term, I feel that the key main risk is what it is. We'll see, in the next few months, couple of quarters, if there is anything more to know about the situation. But I feel relatively confident. We shouldn't be excessively.
Yeah, Fair Group, New Street Research. Always grateful for your time and your reaction to what was a surprise piece of news this morning. Thank you. Let's stick with Musk. Over the weekend, Elon posted on X, formerly known as Twitter, that he's going to have an MRI of his neck and upper back, and he's going to find out whether or not he'll need surgery. This, of course, ahead of a proposed cage fight with Meta's co-founder, Mark Zuckerberg. Joining me out of DC, Bloomberg's Jackie Davalos. You and I have been through all of the posts, all of the timelines, all of the ideas. What do we know is the latest about this proposed cage fight?
Well, Ed, we know that a cage fight is still up in the air, so our eager audience out there shouldn't put their bets in just yet. But what we do know is that Elon Musk sort of put the kibosh on what seemed to be an advancement in a proposed match between the two tech billionaires because of his injury to his upper neck and to his neck and upper back. Now, it seemed to be escalating earlier in the day because when Elon Musk first posted that Sunday that the match should be live streamed on X and that these proceeds would be going to charity, Mark Zuckerberg actually responded to that and said, hey, look, I suggested that we have this on August 26th, haven't heard back. And so a physical match may not be playing out, but they're certainly throwing punches at each other on their respective platforms already.
You and I cover technology, and the platforms are at the heart of this. You mentioned Zuckerberg's response, Threads being more reliable. Outside of the tech, what do we know about the training that's going on? Like, is this real, Jackie? Are they really gearing up for this fight?
Well, they've both been posting pictures of them training. We saw that post that Mark Zuckerberg had of him with this really heavy vest that he was bragging about how fast he could do this particular training session. I mean, they're really putting themselves out there in this way that, at least for Zuckerberg, it's a little uncharacteristic of him. For Elon Musk, not so much. But, at the end of the day, this isn't really about a cage match. I think what a lot of tech watchers out there realize is that the competition between the two really has intensified because of this tit for tat about the social platforms themselves. And so I think this is a culmination, probably a much more entertaining one that we normally see play out, but certainly one that's still a little bit up in the air.
Bloomberg's Jackie Davalos, everything about the Octagon out of DC. Thank you very much. Now, look, we spent the last couple of weeks talking about the rebranding of Twitter to X. But what does Martin Grasser, the co-designer of Twitter's original iconic bluebird logo, have to say about the change? Have a listen to this.
I think with the letter form itself, it's a tough solve that they have to come up with because it's angular and sharp. It has an aggressive construction, and so I think the challenge that they'll have is how to define what X means, how to make it feel welcoming and approachable in its own way. And it's an incredible opportunity to have a single letter domain. I think there is only a few of them in the world, and they really get a chance to sort of say, define a letter in the alphabet. The same way, people think about the bird today. I think, 10 years ago, there wasn't this emotional attachment to the bird that we see